Morning. Welcome to Ada 247 Jab Cab English Medium channel. I hope all of you are doing fine. Today we'll be starting off with the Maha Marathon of IE and IFS. As you know that tomorrow is the examination day, and when we talk about the overall criteria which we must fulfill right now is good number of questions we must practice. Right? Practice is the only thing which you must focus on, because all the consolidation, whatever you have studied in the past, or for that matter, you will be studying in these few hours which are left before the examination, they will be in your mind. You can retain only when you apply those concepts. Fine. So application part we'll be doing today. We'll be covering all the modules A, B, C, and D via questions. Some concepts will be there. Your queries will also be taken up. So everything which you require to crack this examination, maximize your score, will be covering in this Maha Marathon. Fine. So if you can hear me properly or see me properly, just give me a heads up. Fine. So yes. Good morning. Good morning, everybody. Fine, fine. I can see that AV is okay. Okay. All okay. Fine. So when we talk about the questions, let's start. Let's begin our discussion with the question based on lease. I want everybody to participate, because ultimately the agenda is that whenever we are having one question, we should discuss it also. Fine. Whatever queries we have, you must discuss, clarify your doubts, and ultimate clarify your overall concept also. Fine. Concept clarity you can also get in this particular session. Okay. Right. So first question in front of all of you. Try to answer this question based on leasing. A construction firm needs a new crane. They are analyzing leasing, financing, and hire purchase agreement. Which of the following statements correctly identifies a fundamental difference in how these two options would impact the firm's financial reporting and tax position? Tax position also, both the things. So when we talk about the lease finance or hire purchase, what is the core difference here? The difference lies in one thing itself, that either you will be owning a particular machinery, or for that matter, you are only having the right to use it. Fine. Right to use, we have the lease, and owning it in the hire purchase. That is the difference, the major difference between your hire purchase and lease. In some type of lease, you will be given chance to, buy also the machinery, but at the end. But in the hiring, in the hire purchase, you are entering the agreement with that mindset only. That yes, I will be the owner in the end. So what is the right answer? In leasing finance, the firm, the lessee, can claim depreciation on the crane, whereas in hire purchase, only the seller can claim it. When you talk about lease finance, the firm, the lessee, can claim the deposit, whether it is true on the crane. Hire purchase, only the seller can claim it. So hire purchase, you become the owner, so you can claim it in the end. But when we talk about lease finance, you can only claim rent as the expense. Then under the hire purchase agreement, the firm becomes legal owner immediately upon the first payment, no, in the end, last payment. For tax purposes, a firm using the lease finance treats the entire rental payment as an expense, whereas a firm using hire purchase only treats the interest position of the installment as an expense. Installment as an expense, or for that matter, for your lease finance, it will be the rent as an expense, right? The correct answer will be option C. Good, good. Tax purposes, only one thing you have to keep in mind, that what is being treated as the expense. Lease finance, always remember, you will be treating the entire rental payment, because that is what you are paying. Fine. You are paying rent to use that particular property. Fine. So rental payment as the expense, and whereas in the firm using hire purchase only treats the interest portion of the installment as an expense. Fine. Yes, C is the right answer. So in lease, what you will get? No depreciation for you. Fine. Whatsoever, no depreciation will be there. You don't get a depreciation here, but you can claim one thing: full lease rent as the expense. Fine, as an expense, full lease rent you can full lease rent you can claim as the expense. So you still will be getting the tax benefit. Fine, just like you get in your salary account, or for that matter the gross salary which you earn. In hire purchase, what will happen? You will get the depreciation. Why? Because you are the owner. So you claim the depreciation also, interest also, and both will reduce your taxable income. Fine. The deduction will be claimable there. So which one is better? For the long term, hire purchase is better because you will get the depreciation plus the interest. But in case of lease, the higher expense, the full rent, you can get it for the short term tax relief. Fine. So short term, always remember lease. For long term, we have hire purchase. Now, when you talk about the difference, point of difference, very, very important. In this particular chart also, you will get some type of questions from here also. Point 0.5 marker they can ask. So mark this very, very important. Lease finance, you use the asset by paying the rent. Ownership stays with the owner. In case of hire purchase, you buy an asset in installments. Ownership comes at the last payment. Ownership option in lease finance, usually there is no option, but in financial lease you can. And why in financial lease? Because lease is of longer period of time. After 10 years you can buy. And why the intent of buying arises in the financial lease? Because of the lesser price you have to pay for the same product which you have used for so long. Hire purchase, yes, ownership after the final installment, and you enter the contract with that mindset itself. Payment nature, full rent is treated as the expense, and in case of hire purchase, only interest part is your expense. Yes, yes. C is the right answer. Good morning, everybody. This class will be for, I think, 3-4 hours. 3-4 hours. Payment nature, sorted. Full rent is treated as the expense, and hire purchase, only your interest part is the expense, and principal is the asset cost, because you are paying to own something. Fine. What extra you are paying apart from the principal, that is your interest, and that will be your expense. Only that is expense. Depreciation claim, the owner claims the depreciation in case of lease finance. Hire purchase, the buyer, the hirer claims the depreciation. Tax benefit for the lease finance, you will find that depreciation benefit goes to the lessor, the owner only. Fine, who is owning this particular property which you have leased. Lessee, rent as the expense can be your tax benefit. For hire purchase, the buyer, it has both the depreciation as well as interest deduction, and ultimately lower tax he or she has to pay. And what is the purpose of this depreciation claim? If anybody is missing the point here, depreciation claim simply it helps to pay you lesser tax. The amount you are paying, it will be you can say subtracted from your tax obligation, and then the tax will be calculated, because depreciation is treated as non-cash expense. Fine. Now let's talk about the NPS Tier 1 and Tier 2 accounts. Which of the following correctly identify the difference between these two, Tier 1 and Tier 2 accounts? So tier 1 requires a minimum investment of rupees 1000, while tier 2 requires only 500. No, when we talk about tier 1, there the minimum investment stands at 500, and your tier 2 it stands at 1000. Tier 1 funds are locked until the age of 60, whereas tier 2 funds can generally be withdrawn anytime. Anytime you can withdraw. No, tier 2 funds. More tier allows the for additional tax deduction for 50,000 under the section 80 CCD. In tier 2, no tax deduction as such. Fine, additional tax deduction. It is available only for some specific government employees who have entered into the NPS tier 2 with the intent of saving tax. Apart from that, no. Funds from a tier 1 account can be moved into tier 2, but the reverse is not possible. From tier 1, can we move it to tier 2? No, we cannot. So the right answer comes out to be option B. Yes, tier 1 funds are locked until the age of 60. Tier 2 funds can generally be withdrawn anytime. Good, good. B is the right answer. And this table is important for our exam. So who can open which type of account? We must understand it, fine, before entering into the exam tomorrow. NPS tier 1 any citizen can open. When we talk about the NPS tier 2, only if you have the active tier 1 account. Only when you have the active tier 1 account, then only you will be able to open the tier 2 account. Always remember that is the eligibility criteria. Minimum investment 500 for tier 1, for tier 2 it is 1000. Lock-in period locked until the age of 60 in case of tier 1. Here tier 2 no lock-in as such, but if you have invested for the purpose of tax deduct for claiming the tax deduction only, then there will be a lock-in. So no lock-in except 3-year lock-in for the central government employees claiming the 80C tax deduction 80C benefit, section 80C benefit. Tax benefits NPS tier 1 deduction up to 1.5 lakh under the section 80C and additional 50,000 also under the section 80CC D1B. NPS tier 2 no tax benefit, fine, no tax benefit whatsoever for the private employees. For your central government employees, you can claim it the deduction under 80C with 3-year lock-in. 3-year lock-in will be there. Then comes your withdrawal rules in case of tier 1. Partial withdrawal up to 25% is allowed after 3 years. This question is very, very important. Fine. Withdrawal rules when you can withdraw from the tier 1 after 3 years and that too with some terms and conditions. Fine. So partial withdrawal up to 25% allowed, but after 3 years for a specific reason. For specific reasons, the list is there. Whether these reasons are met or not, then only you will be able to withdraw it. At the age of at the 60 years, 60% lump sum amount you can withdraw. Fine, the whole amount 60%. Fine, supposedly 100 is the amount. So out of that 60% lump sum you will get, and 40% will be converted into your monthly pension. Then we have NPS tier 2. You can withdraw anytime, no restriction as such. Tax on withdrawal 60% corpus, which is given to you lump sum. It has no tax obligation. Fine. Okay. For NPS tier 2, withdrawal amount will be added. Fine. Whatever the withdrawal amount is, that will be added to your annual income, and accordingly your tax slab will be decided, and then you will be taxed according to the slab. Fund transfer, EPF can be transferred to tier 1, but tier 2 funds can also be moved to tier 1. When you talk about tier 2, you cannot transfer the funds out of tier 1. So simple, tier 1 and tier 2, you can move the funds from tier 2 to tier 1. This is permitted. From tier 1 to tier 2, can you move? Answer is no. Okay. So do remember these small things. 0.5 marker or statement based questions can be asked. Then we have one important scheme of your APY also. We'll be learning APY as well. But this I hope that now it is clear. NPS via the table which we have seen. APY also we have to see in the end. Fine. Next question. Which of the following best summarizes Keynes' overall criticism of the classical theory of interest? Classical theory. As per regime, yes, yes, not allowed. Not allowed. Exactly. Only for those who are entering into this particular scheme with the intent of saving in case of only saving the tax. Fine. That is what we are talking about in tier 2. The intent. That's it. Private employees, no. So when you talk about J.M. Keynes' overall criticism of the classical theory, the classical theory correctly explains saving but fails to explain the investment. When we talk about classical theory, it explains savings, but whether it has explained investment also, yes, because in the classical theory we talk about what? Supply of savings and demand of savings. Supply of saving is ensured by those who are saving the amount, and the demand of saving will be ensured by those who are trying to invest. So they have explained both. The classical theory applies only to developing economies, not as such. Classical theory assumes interest rates are fixed by the government. Fine. It is not fixed by the government. They are of the form of your market forces. Fine. Only market forces will decide. Laissez-faire is the policy which the classical theory assumes. Let it be. No government intervention. The classical theory overemphasizes the role of interest rates, yes, while ignoring the income expectation and your liquidity preference. Yes, that is what was the key criticism, that you are only talking about the interest rates. What about the level of income? How you are generating income when there is no talk about the employment levels? What about the expectations inside the economy? What about the liquidity preference? The people are preferring to stay with the cash, or for that matter invest in the bond. No talk whatsoever. So yes, that was the criticism by GM Keynes. Option D is the right answer. Yes, good everybody, D is correct. What kind of services did IFCI offer to the businesses? So IFCI offers what kind of services? Only advice on how to save money and cut the costs. Basic banking services like your checking and saving accounts, or for that matter tailored financial support like loans for buying the equipment and services like guarantees. Personal financial services such as home loans and insurance. What will be the right answer? Good morning, Gopal. Good morning. Yes, we'll be doing that also. So what is correct? Option C. Tailored financial support like loans for buying the equipment and services like guarantees. Okay. Consider the following statements about the various entities within the World Bank Group. Which of the following statements are correct? So when you talk about World Bank Group, we have 5 entities here. You have to answer based on the knowledge which we have for these 5. The International Center for Settlement of Investment Disputes, ICSID, was established in 1966 to mediate and resolve legal disputes between the international investors and states. So ICSID, yes, it is the arbitrator, the mediator for the investment disputes. Multilateral Investment Guarantee Agency (MIGA) was created to protect the investors against non-commercial and political risks in the developing countries. So that is also correct. MIGA twofold responsibilities are there. First, to attract the investment for the developing countries, and once the investments are there, then protect the interest of the investors. The International Finance Corporation (IFC) is the largest multilateral source of loan and equity financing for private sector initiatives in the developing world. That is again correct. India is one of the founding member of International Center for Settlement and Investment Dispute (ICSID). Well, this is correct or not? Answer is no. India is not even a member of ICSID. What is the right answer? IFC is for the private sector, fine. How you will be ultimately providing the push to the private sector via the investments? What is the right answer here? Correct answer is option A, B, and C only. Okay, so India is a member of IBRD, IDA, IFC, and MIGA. Fine. India is a member of all these, but it is not a member of ICSID. Not a member. Okay. Now, how do infrastructure asset owners primarily benefit from using the invites as a financial vehicle? So when we talk about investment trusts, how we are benefiting? Infrastructure investment trust, or for that matter, overall when we talk about your real estate also. Right? Here the infrastructure asset is asked for real estate also. The primary benefit will remain the same, pooling of the resources. By completely transferring the ownership and management of infrastructure assets to investors permanently, by raising the funds from a diverse group of investors while distributing the cash flows generated by assets on periodic basis. So you are doing what? Raising the funds from various investors and distributing the cash flows generated by assets on periodic basis. Fine, there is no as such maturity period. Fine, no maturity period as such that after 3 years, 10 years you will be receiving the payment. Periodic basis. By borrowing the funds at fixed interest rates without sharing any income from the assets, whether this is correct or not. By using invites only as a temporary storage of funds before project completion. What is the right answer? Correct answer is option B. Raising from the diverse group of investors. Various investors will be pooling their funds in a particular trust, right? Investment trust we are talking about, and then distributing the cash flows generated on periodic basis. That is the major benefit, primary benefit of these investment trusts. Fine. So correct answer is option B. Good everybody. Now let's talk about one case. Which definition of economics most closely aligns with the neutral, value-free approach observed by Ms. Neelam Verma? Ms. Neelam Verma, a policy intern, is comparing how different economists define the scope of economics. She notices that some definitions emphasize material wealth, while others deliberately avoid judging the judging whether the goals people pursue are good or bad. Right? Deliberately. The definitions we should remember whenever the question arises, or for that matter, in the examination, we have the question of your definitions. Three definition must be in your mind. One is your wealth definition, then welfare definition, and lastly, you also have the scarcity definition. She finds one approach particularly useful for policy analysis. And when we talk about the modern day policies, they draw their direct inference from which particular definition, from the Lionel Robbins definition, right? Scarcity definition, because ultimately the book which Lionel Robbins wrote, it talked about the economic analysis, or for that matter, the policy know-how. Useful for policy analysis because it treats economics as neutral with respect to ends and focuses only on how efficiently resources are allocated among the competing uses. Right. So when you talk about ends and for that matter overall efficiently usage of the resources, we are talking about what? We are talking about the scarce resources. The resources are scarce, that is why we must use them efficiently, and for that Lionel Robbins gave the definition of economics. So what is the right answer? Lionel Robbins scarcity based definition. Adam Smith wealth center definition, yes, he gave the wealth center definition. Welfare oriented definition given by Alfred Marshall. But here in this case, we are talking about what? The scarcity definition. Fine. Policy analysis, keywords, focus on the keywords. Policy analysis directly relates to Lionel Robbins' work. When you talk about the ends, fine, ends, or for that matter, efficiently using the resources which you have because they are already scarce, that is why you are managing those. Correct answer is option C. Fine. Now, when you talk about GDP at factor cost, simple formula-based question. Let's try to answer it as soon as possible. GDP at factor cost via income approach. So, GDP at factor cost you have to calculate, and via income approach, when you talk about GDP at market price, it is 20 lakh crore. Indirect taxes 1.5 lakh crore. Subsidies 60,000 crore. So, market price you already have. What you have to do? Add or subtract the taxes and subsidies. Right? GDP at factor cost you have to calculate. What is the right answer here? Correct answer option A will be there. Why? Because the simple formula minus your indirect taxes and we will be adding the subsidies to calculate at factor cost. Right? Normally we do what? In the factor cost, we add the taxes, subtract the subsidies, but here the reverse has been asked. Okay. So we'll be doing what? Subtracting the taxes, adding the subsidy. So 20 lakh minus 1.5 lakh plus 60,000, you get the answer as 19.10 crore, 19.10 lakh crore. Yes, A is the correct answer. Here, any doubt, guys? Yes, yes, A is the right answer. Okay, do not ignore this 10,000. Next, why is private placement generally considered a faster route for raising equity capital? We often say na, that private placement is the faster route of raising the capital, but why? Why it is there? Along with that, the second position is held by our QIPs, institutional placements. So why? What is the reason? Because it eliminates the need for issuing the shares at market determined prices. It is exempt from all the provisions of company law. It guarantees subscription of entire issue by institutional investors, or it involves fewer investors, that is true, private placement only for limited people, limited investors, and avoids the extensive disclosure requirements of public issues. Correct answer is option D. Yes, good. D is the right answer. Okay. Now, what about the shadow banking concept? Fine. Shadow banking. So when we talk about in the context of shadow banking as defined by SFSB, Financial Stability Board, and its interpretation in case of Indian financial system, which of the following statements are correct? So shadow banking, try to read uh, these four statements. Hardly you should take 10 seconds to read, right? Because that's the speed which we must maintain for the exam. Yes. So what is the right answer here? Everyone. Correct answer is option B. When we talk about the second statement, na, let's read one by one. Shadow banking refers to the credit intermediation conducted outside the regular banking system. Fine. You are having some part of your business, whatever you are doing, and you are doing it like the banking. Fine. Whatever the banks are doing, bank-like functions you are performing. That is the overall criteria of shadow banking. Normally, we think that NBFCs are there and they are only performing the functions like shadow banks, but answer is no. Apart from your NBFCs, also various companies, various financial institutions are working like shadow banks. So A is correct, definitely. Shadow banking in India include only the deposit accepting NBFCs as they mimic the traditional banks. So when we talk about the NBFCs, they mimic they mimic the traditional banks, that is correct, but they are not the only financial institutions which come under the shadow banks in India. Right? So here the only word is the ultimate eliminator of your option or statement B. Activities such as securitization, securities lending, and repo transactions are categorized as shadow banking activities due to their role in funding intermediation outside the traditional banking. So this is also correct. Entities such as hedge funds, money market funds, credit investment funds, all are internationally considered as the part of shadow banking ecosystem due to their role in indirect financial intermediation. So in India, you will find some of the services which are there from these two statements. There will be some services like we have in money market funds, some type of services we can treat as shadow banking. But overall, as a concept of shadow banking, you will find that across the globe, credit investment funds, all the money market funds and the hedge funds, they come under the purview of shadow banking. Fine. Shadow banking, what is happening? That we are doing some of the activities which the banks do. That is the word, that is the reason why this word shadow has been used, right? You are not entirely a bank, but having some business activities which replicate, or you can say which is more or less similar to the banks. Okay. And what are these activities? In case of your NBFCs, or for that matter, when we talk about the securitization services, your repo transaction, securities, lending, all these are what? These are the services which the banks are also providing. Fine. Just imagine that NBFCs are doing what? Some loans they are providing. And who else is providing loans? Banks. Their primary earning is from the loans only. So some part of the core activities of banks, if you are performing, then you are participating in the shadow banking. That is the simple criteria, fine. So overlapping criteria, you can say, like these are the banks, fine. Then all those financial activities which you are doing apart from the core banks, like here we have the NBFC, so this task will be accomplished by the NBFCs also and banks also. When we talk about some securitization activity, some type of securitization companies doing what? Providing the securitization services, and those services are provided by the banks also. So overlapping services with the banks. All those services are overlapping? No, but some services are there, and they form the majority chunk of your business, right? Yes. Fine, fine. Okay. Which currency was added to SDR basket during the review in November 2015 and made effective from October 2016? Yes, yes, business correspondents also, they perform those activities, and which are a part of your banking, regular banking activities, fine. The concept of shadow banking started from that intent only, that we must engage some other entities in the business, because we have huge inflow of work for the banks. Banks cannot handle everything, right? Which currency was and added to the SDR basket, whether it was Indian rupee, Chinese renminbi, Swiss franc, or Canadian dollar? The right answer is Chinese renminbi, RMB. B is the right answer. Yes, good. Everyone with B? SDR. What is the nature of SDR? It is neither a currency nor a claim. Always remember, if they ask in the exam, you are not having it in the form of currency. Rather, it is the culmination of the currencies which you are holding in the basket of your currencies, right? So one basket is there, and various currencies have been added to it. What all currencies are there? We have US dollar, we have euro, yuan, yen, and pound. So the ultimate criteria of review, it was applied in 2015 also, and in 2016 you will find Chinese renminbi was added into the list of currency basket. So now the question arises that the review happens how often? So every 5 years or earlier you will find the review, to ensure that the basket reflects the relative importance of the currencies in the world. Value of the SDR, it is determined daily basis, and the reviews are the reviews are used for the to assess your appropriateness of financial instruments comprising the SDR interest basket. What you have to remember for your exam, every 5 years the review will happen, or earlier also, and the value of SDR is determined on daily basis, 5 years and daily. Okay, so World Bank, let's just quickly go through the other international organizations apart from your IMF. We have the World Bank, which has the headquarter in Washington, DC. What is the aim of your World Bank? That is important. Point 5 marker question has already been asked from here. Aim is simple: to elevate the poverty in developing countries. And these are the five organizations which club together, they form the World Bank group. And normally when we call the World Bank, right, World Bank is what? IBRD and IDA, because they provide the direct funding. So IBRD and IDA, when you talk about what is their role, to provide long-term funds to the countries. And which type of countries? IBRD to the countries having the per capita income between 1025 to 6055 US dollars. So more or less you can say till the lower middle class and lower middle income economies, and just above, right? Because 4515 is the threshold for the lower income, lower middle income countries. Just above that, you can say till there you are providing the funding in from the IBRD, IDA for the poorest countries. IFC to promote the private sector development. That is the agenda here. MEGA, as we have seen, twofold agenda is there. One, to provide the FDI inflows to the developing countries and providing the protection for the investors. ICSID, it is just the arbitrator, International Center for Settlement of Investment Disputes. India is a member of IBRD, IDA, IFC, and MEGA, not a member of ICSID. Then comes WTO, World Trade Organization. It was founded in first January 1995. And when we talk about the important part of WTO, it is the uh, MC, fine? This ministerial conference, very, very important. Ministerial conference, what is the agenda? Why we are having this ministerial conference after approximately every 2 years? It is the top decision making body, and it is just a meeting of various countries, trade or commerce ministers, in order to discuss the trade disputes, right? What the trade disputes are there, or for that matter, what you are facing, what difficulties you are facing while trading with XYZ country, like that. And this ministerial conference just now it held, I think yes, in March 2026, Cameroon, the conference was held in Africa, and it was 14th MC, fine, 14th ministerial conference. Earlier 13th was there, okay, in 2024. Now the latest one is 2026, 14th MC in Cameroon. Apart from that, in the November examination, we have seen that some regional economic cooperation questions were also asked. Primarily, they asked the question from BRICS. Right? So it makes it really important for us to understand that all those organizations which are present in our syllabus, we must go through at least once, fine, at least the important parts of those. Because BRICS was not even in the syllabus, fine, not even in the book also. So, what are the important organizations which we should keep in mind? First is OPEC for your examination. Organization of your petroleum exporting countries, OPEC 1960. 13 oil exporting developing countries that coordinate and unifies their petroleum policy, because they are the stronghold of petroleum. Everybody knows that. OPEC was founded in Baghdad, Iraq, and the members include Iran, Iraq, Kuwait, Saudi, Venezuela, Libya, and UAE. These are the important ones. Fine. So you have to remember only important ones. If you can remember all the 13, that will be good. OPEC's headquarters is in Vienna. Very, very important. You must remember at least this fact. Where is the headquarter? It is in Vienna. Apart from that, Qatar terminated its membership, then sometimes back rejoined, and ultimately then again exit happened. So that is not important. What is important is what is the purpose of OPEC? That is to coordinate and unify the petroleum policy of the oil exporting developing countries. And where is the headquarter? In Vienna. Then comes G20, 1999, it established, and whether India is a member of G20 or not, that can be a question which they can ask. So yes, India is a member of G20, and what is the significance of G20? They see normally, though they just meet and they discuss about the various issues. Right? Some random outcome can come, let's just be very honest. But the importance for our examination, its membership is over two-thirds of the global population and 85% of the global GDP and more than 75% of the global trade. So if you club these 20 countries, you will find that overall across the world, two-third population lives in these countries clubbed together, all of them. 85% of the global GDP comes from these 20 countries, and more than 75% of the global trade comes from these countries. So we have the big countries here, big countries in the form of population, also in terms of population, trade, and GDP, like China and India for population. Trade also, China is there. Then we have USA. USA is there, United States. Also, we have Japan is there. Japan is also there. Right? So these major countries you must know. UK, yesterday only something happened with the UK and the US. Fine. Then we have BRICS 2009, established in 2009, and this was the question they asked. What type of question was that? They simply asked the members, find the full form of BRICS. So Brazil, Russia, India, and China, they were the founding members, the original members. And in 2010, South Africa joined, forming the BRICS. Ultimately, we saw BRICS formation. Represents over 40% of the world's population. Again, India and China are there, and roughly 37% of the global GDP. Further, it has expanded in 2024-25 to Egypt, Ethiopia, Iran, Saudi, UAE, and Indonesia. And what is the purpose here? The group simply aims to promote economic cooperation, increase geopolitical influence, and reform the global financial institutions. See, in 2009, when it came, the BRICS, we were very much clear that all the developing countries' voices should not go unheard. Right? That was the agenda. So Russia joined the ultimate idea, and we had this BRICS. But for our exam, the members are important. Fine. Which of the following best represents a concept studied in macroeconomics rather than microeconomics? So, what will be the concept? Best represents the concept studied in macro rather than micro. In economics, we are studying the aggregate things, fine. And what about the micro? In micro, we are only concerned about the individual things. So, keeping that thing in your mind, try to answer everybody. Which of the following best represents the impact of a price increase on the demand for single company smartphone? Single company, microeconomics, not macro. Macro studies aggregate country, group of countries, world, like that. The determination of wages for workers in a textile industries, and wages of of workers, some workers who are working in the textile industries. Again, we are talking about some industry, not all. The the decision making process of an individual household regarding savings. And regarding savings, the decision making process of the individual household is there. But again, we are talking about individual entities here. So micro will be there. The effect of country's national uh, budget deficit on the overall unemployment rate. Yes, when you talk about the country's national budget, when you talk about the overall criteria of a nation, then we are doing what? The discussion of macroeconomics. Correct answer is option D. Yes, good. Excellent job, guys. D is the right answer. Fine. So such type of cases will be there in the exam. Do not get confused. Just keep the keywords in your mind. Individual for micro, aggregate for the macro. Which statement best describes the dovish stance on monetary policy? Dovish stance. What is dovish stance? So when you talk about the monetary policy, RBI has two types of stances. One is your dovish, wherein the money supply is increased by the RBI. In case of hawkish, the money supply will be restricted. And how the RBI will be increasing money supply? By decreasing the repo rate. How the RBI will be lowering down the money supply? By increasing the repo rate. So these are the things which you should keep in mind. The central bank is focused primarily on fighting inflation, even at the risk of slower economic growth. So, in case of dovish stance, you are trying to increase the money supply. Inflation arises, or inflation will be there when already there is more money in the market. Fine, more money can lead to inflation. The central bank is likely to raise the interest rates and reduce the money supply. Central bank, when we talk about raising the interest rates, yes, they are increasing the interest rate, but not in case of dovish stance. Fine, interest rates will be raised, money supply will be reduced in the hawkish stance. The central bank prioritizes supporting the economic growth and employment, even if it means tolerating slightly higher inflation. Fine, so supporting the economic growth, how? By supplying the money. That is your dovish stance. Correct? C is the right answer. Okay, good. C is correct, everyone. Department of Telecommunication under PPP model launched Tarang Sanchar, a web portal for what? Tarang Sanchar is a web portal for everyone. Try to quickly answer. Let's just pick some questions here which we can answer within a time span of what? Within a time span of 2 or 3 seconds. Right? There will be such questions, right? 2 or 3 seconds. So when I talk about PPP model of Tarang Sanchar is for what? The harmful EMF radiations which are emitted by the so-called EMF radiations, whether they are harmful or not, which are emitted from the mobile towers, right? In order to justify that no harm is done to the human body from these EMF waves, one portal was created by the government, and that portal will provide you the information on EMF emission compliances. B is the right answer. B is correct. So Tarang Sanchar, here you can see the screenshot from the portal itself. It provides info on electromagnetic fields, right? That mobile tower is emitting the waves. So the locals were concerned, the people, the individuals who were residing very near to these mobile towers, they were concerned about their health. So government created Tarang Sanchar portal, and there you can see on real time that what is the level of EMF radiations which the mobile tower is emitting. It is under the PPP model, public-private partnership. Apart from that, in communication infrastructure, what you have to remember that FDI cap has increased to 100%. Earlier it was 74%. Now it has been increased to 100%. Not now, prior to I think 2024 itself, but yes, it is important for your exam. Then another type of infrastructure which you must remember is your renewable energy. RE infrastructure, in the Indian initiatives, you will find some type of targets and Panchamrit commitments also will be learning in this session. Renewable energy, it consists of solar, wind, hydro, biomass, and WTE, waste to energy. Target is India's ambitious renewable energy target of 500 gigawatt. This is the number which you have to remember. Achieving the 500 gigawatt energy capacity from non-fossil sources, that too by 2030. FDI in renewable energy sector is permitted up to 100% under the automatic route. When we talk about the rankings, they are very important for our exam. So solar PV power, the India's rank in solar PV power is third globally now. Cumulative capacity stands at 123 gigawatt, more than 123 gigawatt, and we have surpassed Japan. Earlier we were fourth. Now for our exam we have to remember third. Wind power, we are fourth globally, and total renewable energy, total capacity, we are third. So in total, we are third. When you talk about the solar, then also we are third. For the ultimate wind, we are fourth. So 3, 3, 4. That's how you have to remember. Okay. According to the World Bank, if a person is living on dash or less, then he or she is living in extreme poverty. So if a person is living on 2.90 per day, 1.90 per day, 2.515 per day, or 3 per day, 3 US dollar per day, we will be calling a case of extreme poverty whenever a person is living on US dollar 3 per day or less. Fine. So D is the correct answer. Fine. So these small, you can say points, data points, the data, the ultimate figures are very important. Yes, B is the right answer, everyone. Good. For this question, consider the following statements regarding ISLM model. So IS curve represents the equilibrium in market based on the real factors and shows the relationship between the interest rate and level of income. So IS curve simply represents what? It represents the goods market. And in case of goods market, whether we are talking about the real factors, the demand and supply or not, yes. If in the goods market, you have to add something, you have to actually add something, then you must do what? You must do the cultivation. Like for example, in the goods market, can you alter the price of the goods like potato or for that matter onion or tomato just by increasing or decreasing some rate of interest? No, you have to actually grow these products, fine, actually ensure the supply of these products. Why? How? Via your cultivation. Via cultivation we have to do that. So real factors we are talking about in the IS curve, that is your goods market. The LM curve represents the equilibrium in money market and shows the relationship between the interest rate and the level of income, fine. LM curve talks about money market where you are doing what? Increasing or decreasing the repo rate, fine, like the RBI is doing. The intersection of IS and LM curves determine the unique combination of interest rate and the national income that simultaneously satisfies both goods market and money market equilibrium. IS, LM, they interact, and this point of intersection is known as what? It is your equilibrium point. And the intersection is between what? Two markets, goods and money market, right? So correct answer comes out to be option D. All of the above are correct. Okay, D is correct. Good, good. Everyone is with D, right? So ISLM model in economics, it was established by these two gentlemen, John Hicks and Elvin Hansen. It's also known as Hicks and Hansen model. Then what does IS represents? It represents investment savings. LM represents liquidity and money. For our exam, what we have to remember that IS curve represents the goods market, LM curve represents the money market. So when we say goods market, we are talking about the goods market in a particular country for a particular time. So for Indian context, you will find this IS curve, or for that matter, this goods market, fine, not IS curve. Goods market is driven by the union budget, fine, the expenditure or the revenue part. When the Ministry of Finance increases the infrastructure spending, the curve will move. That is just one example. Whenever the government initiates the money supply, or for that matter, government is decreasing the money supply, then which curve will move? Your IS curve. Always remember, Government of India, IS, last to II. Then LM curve, when we talk about here, which particular entity will be doing some tasks in the country and this curve will move. So for LM, always remember monetary policy, monetary, M for monetary policy. Just try to relate MM, monetary policy. And monetary policy is governed by whom? By RBI. So IS curve, always remember Government of India, whenever changes the money supply, the IS curve will shift. For LM, always remember whenever the RBI is intervening via its monetary policy. So this is the interaction matrix which you should remember for your exam. Fine. No need to look into the curve and then interpret that yes, this dot moves here, that equilibrium moves there. That is also a concept which we have done in our classes also. But right now focus on the actual thing from where the question will be asked. So policy type, when we talk about the policy type, there are two economic policies, right, primarily in any country. One is your monetary policy, another is fiscal policy. Monetary policy is for whom? It will be the policy, the economic policy by RBI or the central bank of a country, governed by the RBI or central bank of the country. The fiscal policy will be governed by the government of the respective nation. So whenever there is a fiscal policy, always remember which curve will shift. The goods market curve, which is your IS curve. So fiscal IS will shift, IS will shift. But when the expansionary fiscal is there, fine. The government is doing what? Government is increasing the spending, reducing the taxes. If your tax are reduced, you will have more income, na? Income will rise. So that is what? That is your expansionary policy. Fine, expansionary fiscal policy adapted by the government. So when the expansionary policy happens, IS will shift towards right. The GDP increases, yes, the money supply is there, everybody is doing their jobs, and ultimately production levels are high. And GDP is what? Ultimate measure of the production level itself. So it also increases. Impact on interest rates also rise. Right? So always remember they will increase in the expansionary fiscal. For your fiscal policy, IS will shift, but contractionary fiscal, it will shift towards left. Why? Because the government has reduced the spending, raised the taxes. Taxes are raised, now you have lesser effective income at your disposal. So impact on GDP, GDP reduces and your interest rate also decreases. Then we have monetary policy. Monetary policy, just now we have seen that LM curve will shift. So LM shifts in the monetary policy, fine. Whether it is contractionary or expansionary, LM will shift. When you talk about expansionary policy as such, so how you can act in this direction? RBI acts in this direction via cutting down the repo rate. That is the expansionary policy. That is your dovish policy, dovish stance that we want to expand the money supply or increase the liquidity. So in that, LM will shift towards right and GDP will increase, and you have done what? Repo rate you have decreased. For your contractionary monetary, RBI will raise the repo rate following a hawkish stance. Fine. And raising the repo rate will do what? It will increase the overall interest rate also, bank rates will also rise, and impact on GDP, the production level will decrease because people now are not interested in taking loans. The money is not at all there in their at their disposal so that they can invest in the businesses, overall impacting the GDP. So it will decrease. Fine. So what is the conclusion then? Fiscal expansionary policy, in the GDP level of income, it will rise and the interest rate also rises. Contractionary fiscal, the GDP decreases or the level of income decreases, and your impact on interest rate, it also decreases. Monetary expansion, you will find that GDP or the level of income will rise and the interest rate are lower. When we talk about the contractionary monetary policy, you will find that interest rates will increase and GDP or the level of income will decrease. One more thing I want to highlight here, the impact on GDP is written here. Along with that, along with the GDP, some terms are related, level of income, or for that matter, your output, right? The journal output of the economy, whatever is written there, they are more or less same because level of income will determine the overall GDP. Level of output will also impact the GDP directly. Okay. Now let's just talk about the SLR, statutory liquidity ratio. Okay, after this matrix, I hope that you won't find any difficulty in solving the questions, right? Which of the following statements describe the SLR? SLR represents the minimum percentage of the bank's NDTL, net demand and time liabilities, that must be maintained in the liquid assets like cash, gold, and other securities. Whether this is right? When SLR represents the minimum percentage which you are holding in the liquid assets, right? That is what we talk about in SLR. CRR is for the cash only, cash and cash equivalents. SLR requirement applies to all the scheduled commercial banks, cooperative banks, small finance banks, and your RRBs. The SLR percentage can be altered by the RBI and is currently capped by law, allowing to set it up to maximum of 40% of the bank's NTTL, maximum up to 40%, right? A decrease in SLR by the RBI typically leads to an increase in the lending capacity of the banks, thus boosting the liquidity in the financial system. So whenever the RBI will decrease the SLR, you will find what banks are having more loanable funds. They can lend more via the loans, and that will increase the lending capacity. Correct answer? Option D, 1, 2, 3, and 4. All of the above. Good. D is correct. I can see Gopal, Shalu, Naresh, Manjula, Shaurya, Murugeshwari, Kiran, everybody is answering. Right? D is the right answer. First is correct, na? Liquid assets like cash, gold, and other securities. Fine. Government securities you are holding. Fine. And one more thing, SLR and CRR. What is the difference there in the sections? SLR is mentioned in which particular act? It is mentioned in the Banking Regulation Act. Which section? Anybody who can tell me the section number here? For CRR, we have what? It is mentioned in the RBI Act. And which section is there? Again, do comment. Just comment S for SLR, what is the section number, and C for CRR, what is the section number. Yes, yes, Mahi, good. D is the right answer. Now, next question, M3. Let's try to answer the numerical here, formula-based question. 42 SLR, okay, 24, 42, 42, yes, RBI Act. Yes, yes, for your CRR, CRR 24, yes, good, good, good. Okay, so we have all the important data in our mind. That is good to know. S24, C42, okay, or is it the opposite? Yes, yes. Okay, so based on the different measures of money supply shown in the table, suppose the following data is it there in the Indian economy. So what is the table saying? We have currency with public 1.5 lakh crore, net demand deposits with the commercial banks 2 lakh crore, other deposits with RBI 10,000 crore, post office savings deposit 30,000 crore, and your NDTL net time deposits with the bank is 5 lakh crore. What is the right answer? For the broad money, you have to calculate broad money M3. Broad money simply talks about what? M1 plus the time deposit. And M1 is equal to what? M1 is currency with public plus demand deposits plus other deposits. So just calculate. We have 1.5 lakh plus 2 lakh. It gives us what? 3.5 lakh plus 10,000. And lastly, you have to add the time deposit, net time deposit. So 3.5 plus 5, it will be 8.5 plus your 10,000, 8.60. Correct answer comes out to be C. Yes, yes, C is the correct answer. Good. Okay, so quickly let's just revise the formulas also. M1 is equal to currency with public plus demand deposit plus other deposits with the RBI. M2 is equal to M1 plus saving deposits with the post office. M3, M1 plus time deposit. M4, M3 plus all the deposit with the post offices except for your Kisan Vikas Patra and National Saving Certificate. Fine. So NSC and Kisan Vikas Patra are excluded from the deposits with post office savings organization. Why? Because of the high maturity period. Yes, yes, C is the right answer. Good, good. Okay. M naught is just the reserve money. So currency in circulation plus banker deposit plus other deposit. Fine. So currency in circulation plus bankers deposit with the RBI plus the other deposits of RBI. In others RBI. That is your M naught. But mostly they will ask from M1, M2, M3, M4 because this is what? This is a reserved money, right? This is reserved money, or for that matter, base money as we call it, right? Fine. Which of the following statements accurately reflects the requirements and penalties related to the CSR activities in India? So statement one, non-compliance with CSR provisions is now primarily treated as a civil wrong, not the criminal offense. So yes, earlier it was a punishable offense where you have to go to jail also, imprisonment was there, but now it is treated only as a civil wrong, that penalty will be there. Fine. Companies are now free to spend more than the mandated 2% of their net profits on CSR in the last 3 years, right? So more than 2% also you can spend, right? The penalty regime introduced in 2020 replaced the imprisonment provision for the defaulting officers that was bought during 2019. What is the correct answer? All these statements are absolutely correct. C is the right answer. Yes, everyone is right. Next question, what is the penalty then? Now it brings us to the question, what will be the penalty? Try to answer. What will be the penalty? The penalty is twofold. One will be levied on the defaulting company, another will be levied on the defaulting officers. Normally, they are the directors of the particular department which is responsible for the CSR obligation. So when you talk about the defaulting company, it is what? 1 CR, or for that matter, twice the actual obligation amount. And when we talk about minimum of these two numbers will be the ultimate penalty. For your defaulting officer, it is 2 lakh or 0.1 of the obligation amount. Right? So correct answer comes out to be 1 crore and 2 lakh. D is the right answer. 1 crore, 2 lakh. Good, good. D is correct. Fine. So CSR activities, the activities, or for that matter, the overall description you will find where Section 135 of the Companies Act, Schedule 7 also provides for the overall direction of CSR activities. Right? Overall, we will find it in Schedule 7. Now comes the question that these CSR activities are applicable for whom? All the corporates? No, only the corporates who are having these criteria fulfilled. Either of these, fine, not all, either of these, either one, or for that matter, if they are doing all, then also it's fine, but at least one of these three. Net worth more than 500 crore, turnover more than 1000 crore, net profit more than 5 crore, right? Companies are now free to spend more than the mandated 2% of their net profits on the CSR in last 3 years. Right? During the last 3 years, whatever the profit you have accumulated, its average will be done, and 2% of that number will be your CSR obligation. If you are unable to meet this obligation number, then what will happen? Penalty will be levied. And what is the penalty? 1 crore or twice the obligation amount for the defaulting company, and at least 2 lakh or 1/10, you can call it zero point 0.1 also, 1/10, 1 by 10, directly we can say 0.1. So 0.1 of the obligation amount for each defaulting officer, right? This is the obligation amount, 2% of the net profit in the last 3 years. The obligation amount is there in front of you. So you will be doing what? 0.1 multiply by the obligation amount. Let's suppose it comes out to be 10 crore. Just imagine. And the another figure is 2 lakh or 2 lakh, whichever is less. So lesser will be 2 lakh. This will be the penalty amount. Okay. Now it has been made only a civil wrong. Earlier it was a criminal offense. Imprisonment clause was there, but now only penalty will be levied. Fine. Okay. What about the CRR? CRR, SLR? We were not having any kind of consensus here. CRR 42, SLR 24, right? CRR, RBI, SLR, Banking Regulation Act. Fine. So which among the following is known as the father of White Revolution in India? MS Swaminathan, Dr. MS Swaminathan, Mr. Varghese Kurian, Dr. Arun Krishnan, or Mr. Durgesh Patel? What is the right answer here? Yes, Operation Flood, father of White Revolution. Option B, Mr. Varghese Kurian. So Operation Flood, White Revolution, milk or dairy products, founder or the father of revolution, Varghese Kurian. We have Green Revolution, agriculture, MS Swaminathan. Yellow Revolution, oil seeds, Mr. Sam Pitroda is there. Then we have Blue Revolution, fish, aqua, Arun Krishnan. So these four fathers you can remember for the respective revolution. Apart from that, the other revolutions, they are important for their field or product, not for the individuals who have instated them. So Green Revolution, MS Swaminathan; Operation Flood or White Revolution, Varghese Kurian; Yellow Revolution, Sam Pitroda; Blue Revolution, Arun Krishnan. Then we have golden revolution, fruits, honey, horticulture. Mr. Nirpak Tutej is there, but no need to remember. Just remember this one, fine, field or product. Golden fiber revolution for jute. So golden for fruits, golden fiber for jute, yellow for oil seeds. Do not get confused between yellow and golden. Yellow is oil, golden is for fruits, honey, and horticulture. Silver revolution for eggs, silver fiber for cotton, pink revolution for pharmaceuticals, prawns, onion, brown revolution for leather, cocoa, non-conventional energy, red revolution for meat, tomato, and your gray revolution is for fertilizers. Fine, fertilizers. Most important out of all these, whatever we have seen, is the brown revolution. They can directly ask thanks to the non-conventional energy field attached to the brown revolution, right? The renewable energy. Evergreen revolution, overall production of the agriculture. Black revolution pertaining to petroleum. Round revolution, potato. And protein revolution, the higher production of protein rich foods. Now let's talk about the FTP 2023. Which of the following statements represents the major pillars? Naresh, important when we talk about this table, this entire table is important. But whether we can remember all these facts or not. So primarily what all must do, that you should learn these two, revolution and the field or product. That is the primary thing you must do. Then after that, if you find time, then you can remember the time period also, or for that matter, fathers of revolution. But primarily, this should be our task. In the exam, they might ask some point 0.5 marker about the period. So it will be there in your mind once you understand that what type of field or product we are talking about. Right? So chronology you can make, but the primary task remains to learn the field or product associated with the respective revolution. Okay, so concerning the core themes or foundation of India's FTP 2023, which of the following statements represents its major pillars? Shift from incentive-based schemes to a regime of tax remission and entitlement. Commitment to ease of doing business, focusing on reducing the transaction cost and process automation. Right? Promoting the export promotion and fostering strong collaboration between exporters, states, and the center. Strategy to leverage the technology by transforming districts into export hubs through e-commerce. What is the right answer? FTP. Shift from the incentive based schemes. Only giving incentives won't work. You have to provide some type of tax remission, some type of entitlement, some type of waiver of the penalty also. Right? That is one of the pillar. Commitment to ease of doing business in every FTP. In FTP 2015 also they have written this ease of doing business. Same has been reinstated here also. Promoting the export promotion and fostering strong collaboration between exporters, states, and the center. Yes, collaboration must be there. Strategy to leverage the technology by transforming districts into export hubs. Right? Right answer is your option D. All of these four are the pillars of your foreign trade policy 2023. Yes, yes, Naresh. D is the right answer. Okay. So the pillars: incentive to remission, so reduction or cancellation of debt, duty, penalty that you must do. Export promotion through collaboration. Exporters will be exporting the products, but they must collaborate with the states, districts, and Indian missions abroad. Then we have ease of doing business. There that must be there. And emerging areas, e-commerce developing districts as your export hubs. Fine, all the districts which have potential, which are industrial districts as such, we will be developing them as the export hubs. Fine, streamlining the special chemicals, organisms, materials, then equipment and technologies. Fine, the SCOMET policy. So SCOMET policy they can ask you directly in the exam. You will find the question from SCOMET policy if they are asking the question from your FTP. Fine. SCOMET policy is very, very important. So what is the full form? S stands for special chemicals, O for organisms, M for materials, E for equipment, and T for technologies. Right, SCOMET. Now comes the goals and targets. Goals and targets in case of FTP 2023. The government has increased our overall export target to achieving the target of 2 trillion US dollar by 2030. Earlier, it was 900 million billion, right? The target was 900 billion earlier in FTP 2015. Now it has been increased to 2 trillion by 2030. And right now, when we talk about the potential, the actual potential, we are not even close to reaching the older target, right? So yes, but for our exam, we have to remember 2 trillion by 2030. Next, which of the following statements is are correct regarding the economic planning and 5-year plans in India? So economic plan, 5-year plans in India. When you talk about the economic planning, you must remember some important 5-year plans, not all. So plan holiday was observed between 1966 to 69. Yes, 1966-69. Definitely, that was plan holiday. And plan holiday, thanks to what? Thanks to wars, droughts. Ultimately, we were unable to have the funding for a full-fledged 5-year plan. That is why annual plans were introduced, known as plan holiday. During the eighth plan, target growth rate was 5.6, and actually we were able to clock 6.7% thanks to the introduction of LPG reforms. Some banks were nationalized during fourth plan. Yes, 14 banks were nationalized. The Planning Commission was a statutory entity. No, it was the executive body. No statute was there, so it is wrong. There was no specific emphasis on industrialization in secondary plan. No, there was. In fact, second plan starts with the focus on industrialization itself. So 4 and 5 are wrong. 1, 2, and 3 are correct. So the right answer is option A. Yes, A is correct. Yes, Aki, you will get the PDF from the virtual library, right? The virtual library's link is there in the description. You can directly download from there. And if you are our paid subscribers and you are added in our WhatsApp group, I'll be posting this particular PDF in the group also. Okay, so there you can directly download. Which of the following statements regarding the India's economic status and government actions can be considered correct? So economic status and government actions, what will be the right answer? Despite being the third largest economy in terms of purchasing power parity (PPP), India remains classified as a lower middle income economy due to its low PCI. Lower PCI, but whether we are in the lower middle income, yes, we are there. Lower middle income. India's high PCI of 1891 places it in upper middle class. Neither we have 1800 as our PCI nor we are in the upper middle class. The government's focus on development through 5-year plans has primarily addressed issues such as poverty, unemployment, but not impacted the overall income levels at all. Whether this is correct or not? No. The income levels have increased. Fine, definitely they have increased over a period of time. So it has impacted the overall income levels. So C is also wrong. B and C are wrong. The economic challenges India faced post-independence, such as illiteracy, unemployment, have been substantially reduced through the effective implementation of developmental policies. Yes, D is also correct. The right answer is A and D. Right? A and D. A is the right answer. A is correct here. Yes, A. Good. So what do you have to remember for the exam? World Bank classification: low income, lower middle, upper middle, and high income. Low income, US dollar 1145 or less. Lower middle income economies, you have to remember this by heart because they here India lies. 11,462,4,515, and India's PCI is roughly right now 2880. Right? Then upper middle income 4,516 to 14,005 US dollar. High income more than 14,005. So India is in the lower middle income economy group. Next, the Smart Cities Mission is a major urban renewal program launched by the government to develop and upgrade living conditions and infrastructure in dash cities all over the country. Which type of cities we are talking about? The cities which are not having the development, fine. They were not having the infrastructure, so smart cities mission was introduced to develop how many cities, to make them smart. 100 cities, right? C is the right answer. So always remember 100 cities, smart cities mission. So launched in 2015, extended twice, and ultimately the aim was to transform 100 cities to provide necessary core infrastructure and clean, sustainable environment. Yes, yes, 100. Good. A medium enterprise is an enterprise where the investment in plant and machinery or equipment does not exceed dash and turnover does not exceed dash. So when we talk about your medium enterprise, what is the investment limit? Investment limit is up to 125 crore. What about the turnover limit? It is your up to rupees 500 crore. So right answer comes out to be 125 and 500. D is the right answer. Yes, D is correct. Good, good. Yes, Sandeep, 100 cities. So micro, small, medium, what are the investment limits? Up to 2.5 crore, up to 225 crore, up to 125 crore in micro, small and medium enterprises respectively. Turnover limit up to 10 crore, up to 100 crore, up to 500 crore in micro, small and medium enterprises. A very important table for our examination. Then which among the following is the correct ratio of minimum investment in plant and machinery or equipment for micro enterprise to medium enterprise as per the latest MSME definition of Government of India? So latest definition of MSME, what will be the minimum investment in plant and machinery for micro and your medium enterprise? So micro enterprises, we have the investment, fine, here they have asked the minimum investment only. Investment in the micro is up to what? 2.5, and in medium it is what? Up to 125. Simply you have to take the ratio 2.5 divided by 125. You will get what? This will get cancelled out. It will be 1 by 5. So this is what? 0.1 divided by 5. This decimal will go and you will get 1 divided by 50. 1 is to 50. B is the right answer. Yes, B is correct. Now let's move on to the Panchamrit commitments. Fine. Which of the following statements correctly describes India's Panchamrit action plan announced at COP26 for climate change mitigation? Climate change mitigation. India will reach net zero carbon emissions by 2070. India aims to meet 50% of its energy requirement from renewable sources by 2030. The total projected carbon emission will be reduced by 1 billion tons by 2030. India targets to bring down the carbon intensity of its economy by less than 35% by 2030. No, less than by 45%. 45%. Fourth is wrong. Rest three are correct. Yes, so A is the right answer. India will reach the net zero carbon emission, that is zero greenhouse gas emission by 2070. India aims to meet 50% via the renewable sources, and the total projected carbon emission will be reduced by 1 billion by 2030. So A is correct. Panchamrit commitments, net zero emission by the year 2070, greenhouse gas emissions will be gone by then. Then we have these four. The remaining four, the target year remains 2030. Fine. Always remember that for the last four, your target year stays at 2030, which is also what? Also the expiry date of your expiry year of your SDGs, Sustainable Development Goals. So achieving 500 gigawatt non-fossil energy capacity by 2030, fulfilling 50% of the energy requirements from renewable energy sources by 2030, and total projected carbon emission by 1 billion tons from now onwards till 2030. 2030, by 2030 you will also reduce the carbon intensity by less than 45%. So just focus on these bold letters. Fine. Next, under the defense manufacturing, which of the following activities permitted for 74% through automatic route? 74%. Automatic route is what? Simply, we are talking about no government approval is required. Fine. Some kind of reporting mechanism will be there for your overall criteria. Reporting mechanism to the RBI might be there, right? What is the correct answer? We are talking about the defense industrial license. Yes, A is the correct answer for 74%. So defense manufacturing, 100% FDI is permitted, but 74% through automatic route and up to 100% via government route. In the automatic route, defense industrial license DIL, and for your government route and the in order to access the modern technology. Fine. So MT is for your government route 100%, 74% automatic route DIL. Now, under the revised PSL guidelines, which of the following statements are correct regarding the new category, the NCF in agriculture sector? Let me just correct this first. I think this is the same question we did earlier also. Earlier in the sense, not here, but in some other session. Otherwise, it will skip. Hmm, yes. So, what is the right answer here? When I talk about the PSL guidelines, which of the following statements are correct regarding the new category NCF in the agriculture sector? NCF category. So overall criteria is 18%. Out of that, 14% is now for the NCF, and out of that, 10% is earmarked for the small and marginal farmers. This is what the PSL guidelines are there. So the term non-corporate farmers, NCF, it includes individual farmers, self-help group, and joint liability groups. Yes, NCF includes all the individual SHGs, JLGs, just corporate entities are not there. So first is correct. Sub-target for lending to non-corporate farmers is fixed at 10% of adjusted net bank credit or equivalent, the credit equivalent of balance sheet exposure, COBEC, whichever is higher. So when you talk about 10%, no, it is 14%. This makes this statement wrong. Loans to corporate entity engaged in the agriculture are also covered under NCF target. No, NCF target is a part of 18% agri target, the overall target. Yes, fourth is right. A is the correct answer. Fine. So when we talk about the RBI revised PSL guidelines in March 2025 and then again in May 2025, wherein in May what they have done, they have decreased the obligation over the small finance banks pertaining to the total PSL norms. Now it stands at 60%. This is the table which you have to remember for your exam. When you talk about agriculture, it is 18% overall and 14% for your NCF category, 10% for the small and marginal farmers. For your UCBs, urban cooperatives, there is no target as such for the agriculture, but the total priority sector lending target stands at 60%, micro enterprises 7.5%, advances to weaker section is 12%. Apart from whatever we have studied till now, one important point which you should remember is the advances to weaker section, that too for RRBs, because it is a bit higher as compared to the other two categories. Here it is 15%. Fine. Very, very important. Okay. The Committee on the Harmonization of Role of FIs and Banks 1998 was formed under the chairmanship of whom? RH Khan, SN Verma, AK Khandelwal, or none of the above? So role of FI and banks, your RH Khan, Khan Committee on Harmonization. Apart from that, we have Chakravarti Committee on micro or your monetary policy. Narsimham Committee on Financial Sector Reforms. Padmanabhan Committee review the banking supervision. Narsimham Committee review of banking sector reforms. Verma Committee weak banks. RH Khan Committee on harmonization of role of FIs and the banks. Yes, A is the right answer. Good. Then the RBI's dash cover a range of regulations including asset classification and provisioning against the NPA. So when you talk about the RBI's prudential norms, fine, they will be covering your regulations, asset classification, or for that matter, your IREC norms also, provisioning against the NPAs also. Correct answer is your prudential norms. Income recognition and asset classification also part of your prudential norms. Next, which of the following statements are correct regarding the sectors of the economy? So we have various sectors, organized, unorganized. The organized sector comprises manufacturing, enterprise, business, school, hospital, and the unit registered with the government, right? The organized sector has higher unemployment than the unorganized sector. So organized sector is always registered with the government, that is correct. But organized sector is having lower unemployment as compared to unorganized sector because here unemployment levels are very high for the unorganized sector. So this is wrong. Informal workers, they are defined as those who work in organized firms or families with all the social security benefits. Informal workers, they are working in the organized firms, but right now they are not enjoying all the social security benefits. Once they will become the full-time employee, then only they will be enjoying the social security benefits. Farming is one of the largest unorganized sector in the economy. Yes, unorganized sector is characterized by small and scattered units, which are largely not registered with the government. Unorganized sector not registered with the government. The correct answer comes out to be option B. Yes, 1, 4, and 5. So 2 and 3 were wrong. 1, 4, and 5 will be the right answer. Yes, B is the correct answer. Good. Consider a low income family in Odisha where jowar, the sorghum, is the cheapest and primary source of calories, accounting for a large share of their budget. If a widespread drought causes the price of jowar to sharply increase, and in response, the family's focus is forced to cancel their marginal purchases of vegetables and milk, subsequently increasing their total consumption of the more expensive jowar. This specific reaction, increasing the demand despite the price increase, is an example of what we are doing. What here? Substitution effect, Veblen good, Giffen paradox, or normal good. Since we are talking about the staple diet, the inferior goods, the correct answer will be Giffen paradox, where even when the price was increased price was there of jowar, you will find despite of decreased demand, the demand in fact increased to compensate for the calories. Fine. So the correct answer is Giffen paradox, option C. Good, good. Good morning, Vikas. Good morning. Exceptions to the law of demand, we have two exceptions. One is Giffen goods, another clubbed together as Veblen commodities. Giffen goods, they are also known as the inferior goods, and here you will be seeing what the prices are high, but the demand is not falling. In fact, it is increasing. For the luxury items, expensive items, we have Veblen commodities. Okay, so yes, that's how you should remember. Giffen, why Giffen? Because the concept was given by economist Robert Giffen. Why Veblen? Because it was given by economist Thorstein Veblen. Right? And what is this word paradox? Paradox simply means that there is some exception. Fine. We are not witnessing what we should witness. Fine. So normally price increases, demand falls, but here we are not witnessing that. We are witnessing indeed increased in demand with increased price. Okay, noticeable consumption or conspicuous consumption, it is related to your Veblen commodities because economist Thorstein Veblen gave this idea that whenever there is a luxury item you are purchasing, it is quite noticeable. Fine, it is not at all a common item, it is a luxury item. Fine. A sunrise sector is characterized by what? By its maturity stage of development with limited growth potential. So growth potential is quite high, not limited in sunrise sector. Sunrise sector typically exhibit a high degree of innovation. Yes, degree of innovation is high. Sunrise sector often attract investors due to their long-term prospects. Yes, that will be correct. Sunrise sector, they are usually having low level of public awareness. No, they have high level of public awareness. The correct answer will be option B. We got 610, I think 6.5 or 610. The foreign trade policy FTP 2023 streamlining the SCOMET policy. What does SCOMET stands for? Simple, we have seen this. Correct answer: special chemicals, organisms, materials, equipment and technologies, SCOMET. Then we have quaternary and quinary here. Quaternary, quinary sectors, they are the secondary sector subsectors. No, they are the tertiary sectors subsectors. So this is wrong. Quaternary sector is known as the knowledge sector. Absolutely right. Quaternary sector includes activities like teaching, R&D, include the employees in the office buildings. Absolutely correct. 2 and 3 are right. C is the right answer. Yes, for this, C will be the correct answer. The total priority sector obligation for the small finance banks (SFBs) has been determined as dash of ANPC or COB, whichever is higher. So we are talking about which number? 60%. D is the right answer. In December 2018, Niti Aayog published its comprehensive national strategy for New India, including clear objectives for 2022-23. It is a full exposition spanning 41 critical areas divided into 4 sections. Which sections? D, I, G. So we have drivers, we have infrastructure, we have inclusion. Fine, inclusion is there. No innovation as such. Fine. So this is strong and the right answer. Fine. Which of the following is not one of them? Innovation is not. Instead, inclusion should be there. So C is the correct answer. G stands for governance only. Yes, yes. Everybody should reply. Fine. Everybody. I can see Kiran, Ramya, Seshu, Naresh. Yes, yes. Good, good. C is the correct answer here. The government launched Stand Up India scheme to provide a business opportunity to those who are either females or they belong to SC/ST category and require financial assistance to start their greenfield business ventures. These individuals are given special loans ranging from dash at least at the low interest rate. So when you talk about the Stand Up India scheme, you must have the business in the greenfield ventures. Fine, that is, the business must be fresh. You are a fresh candidate who's just starting the business. And another important part is the ultimate amount. So it is 10 lakh to 1 CR for the SC/ST category and the females. Correct answer option C. 10 lakh to 1 CR. Yes, C is correct. India's ambitious renewable energy target is for achieving dash from the non-fossil sources by 2030. It is what? 500 gigawatt, which we have already seen. The right answer comes out to be none of the above. Fine. D is the correct answer. Okay, this table, this data we have already seen. Solar third, wind fourth, total third. That is the ranking of India. Okay, now let's move on to the budget. Let's try to see what all we can gather from budget here. Budget is having two components: revenue account and capital account. Two components or two accounts are there. In revenue account, all those spending, all those revenue which is there for short term will be added. Right? Short term means less than 1 year. In capital account, for more than 1 year, or long term, this expenditure and revenue is there. Right? The debit or credit as we call it. Revenue account divided into two components: revenue receipt and expenditure. Similarly, capital account also capital revenue and expenditure. Revenue receipt, we have tax as the major component of revenue of the government. So tax receipt is one of the dedicated component here. Then we have non-tax receipt also. Capital revenue, debt creating and non-debt creating. Debt creating, you are including the money via borrowing that has created a debt on the country. Non-debt, it is your money only, just it is coming to you after long intervals. Like you must have invested somewhere, like the country should have given some loan to some other country like that, and now the money is coming back. Now comes the concept of revenue deficit and fiscal deficit. In case of revenue deficit, you will find that we are considering only revenue account, fine, only revenue account. And in revenue account, what will be the formula for the revenue deficit? So deficit is when your expenditure is much higher, the government's expenditure is much higher as compared to its revenue. Fine. So revenue account uh, will be considered for calculating the revenue deficit. And in revenue account, we have what? Revenue receipt and revenue expenditure. So we'll be subtracting what? We will be subtracting your revenue expenditure from the revenue receipt. That will give you the revenue deficit. Right? But whether it is a holistic picture, no, we don't have the holistic picture here of the budget. Holistic picture comes when we include the input from the capital account also, and that is what we call as fiscal deficit. So fiscal deficit is again the gap between expenditure and revenue, but we are talking about both the accounts, revenue account as well as capital account. So the total expenditure means revenue expenditure and your capital expenditure. Total expenditure will be subtracted from the total revenue generated. So what is the revenue in the via the revenue receipt? What is the revenue via the capital revenue? So that will be subtracted. And in this total revenue, right? Total revenue, we have to subtract this debt creating part, the borrowing part also, because that is not our revenue. We have to pay it back. So subtract the borrowings. That will give you what? The formula for your fiscal deficit. Okay, fine. So revenue deficit formula, total revenue minus total revenue expenditure minus total revenue receipt. Fiscal deficit, total expenditure minus total revenue excluding the borrowings. Then we have effective revenue deficit, where the revenue deficit minus grants will be there. Fine. Revenue deficit minus the grants gives you your ERD, effective revenue deficit. And when you talk about the fiscal deficit, a very important formula is associated with the fiscal deficit, which has been asked in May 2025. So primary deficit is equal to what? Fiscal deficit, subtract the interest payments, fine. You have to subtract your interest payments. That will give you primary deficit. That what is the actual deficit of the government. Fine. So this is the table which can be asked in the exam. I think in November 2025 they have asked also this kind of table, but it is not a difficult table, right? When we look it for the on the first time, you will find that yes, that is very intimidating, very difficult to interpret, but it is not. See what is mentioned in this table. First, it is revenue receipt. Fine. Revenue receipt talks about what? Tax and non-tax revenue. Just now we have seen. Then it has mentioned fourth as capital receipt. Capital receipt includes everything. Your long-term, you can say receipt we are talking about. So recovery on the loans, recovery of loans we are doing. Other receipts, some other investments will be there of the government, and borrowings and other liabilities. So borrowings are a part of your capital receipts. That's why we exclude it while calculating the fiscal deficit. Then total receipt will be what? Total receipt will be revenue receipt plus capital receipt, that is 1 plus 4. That will be a total receipt. Then comes your total expenditure. Total expenditure is what? Whatever the government is spending. So the expenditure will be from where? From the revenue account, so on revenue account, and also from the capital account. Fine. So capital account component is there as well as your revenue account component is there. After that, we have the revenue account in which the most important expenditure part will be interest payments and the grants. And that is the reason why we subtract the interest payments from the fiscal deficit to get the primary deficit, and we subtract the grants from the revenue deficit to get the ERD, effective revenue deficit. Fine. So effective capital expenditure will be your 12 plus 13. Fine. 12 plus 13 grants, because the grants are for what? For the creation of capital asset. You have to add it with the capital account expenditure. That will be the effective capital expenditure. And in the exam, what they have asked in the previous exam cycle, they have asked you the fiscal deficit. So we will come to the fiscal deficit, but if you know the formula, you have already arrived at it. Revenue deficit is what? 10 minus 1. Revenue deficit, we have 10, that is the expenditure in the revenue account, from the revenue account. 10 minus 1, your overall revenue receipt, right? So revenue expenditure minus revenue receipt. Revenue expenditure minus revenue receipt. That's what we have seen in the formula also, revenue receipt, revenue deficit. Then comes effective revenue deficit. How you will be calculating? Revenue deficit is there, you have calculated in 15, so 15 minus 12. What will be the 12th? 12 will be your grants in aid, fine. So simple, revenue deficit minus grants, the formula which we have seen again. Then comes your fiscal deficit. Fiscal deficit is what? 9 minus 1 plus 5 plus 6. So 9 is what? Total expenditure, fine, including your capital as well as the revenue account, minus 1, that is your revenue receipt, right? So revenue receipt, you will be uh, adding in what? Capital receipt also, but only two components are added. What two components? The recovery of loans, that is 5, and other receipts. Right? So we are adding one, that is your revenue receipt, with recovery of loans and other receipt. And what we are doing? We are not adding this, the borrowings part, right? Excluding the borrowings, we are taking the fiscal deficit. This will be the formula for your fiscal deficit. What is that? Total expenditure minus total revenue, excluding the borrowings, right? Okay. And lastly, we have the primary deficit, which is what? Fiscal deficit minus the interest payments. 17 minus 11. 17 is fiscal deficit minus the 11 part, that is your interest payments. Okay. So like that, if the question is there in the exam, what you should do? Simply, you have to apply the formulas. Do not think that this is a big data, how we will be analyzing it. No, everything is given to you. You have the total receipt, directly they have mentioned. You have the total expenditure, directly they have mentioned. And what else you require? You require the exclusion of borrowings, so you will be excluding the borrowings from the total receipt. Here the borrowings are there. So out of these three, you will be calculating what? The fiscal deficit. And they will specifically mention that whether for the actuals you have to calculate, for budget estimates you have to calculate, or for that matter revised estimate. In case of budget estimates, which year they will be telling you. So specific number will be there, and based on that you have to calculate the fiscal deficit. Okay, this is the same table. For more clarity, in the sense you can see once the PDF is there. Virtual library, the link is given in the description only. Once you will see the description, the first link is there. Click on the link below for PDF related to live classes. There is JAIIB virtual library. Just click on the link and you will be able to download the PDF once the class is over. Class will take time. I think it will go till 9:30. 9:30. Okay. Under the CGTMSC, the limit for collateral-free loans has been revised to what amount? So it has been revised to 10 crore. Earlier it was 5 crore. Prior to that it was 2 crore also. But now for the exam you have to remember 10 crore. C is the correct answer. Then which among the following is the aim of Amrut being implemented by the government of India? Amrut is for what? Upgradation of urban infrastructure, rejuvenation of infrastructure, urban infrastructure. So to help the MSMEs upgrade their technology, or to transform urban living condition through the infrastructure upgradation. Right? So the right answer is upgradation of your infrastructure in the urban areas. B is the correct answer. Amrut full form is important. Atal Mission for Rejuvenation and Urban Transformation. Fine. That is the full form of Amrut. Okay. And when we talk about the mission, it focused on various aspects: water supply, sewage management, storm water drainage, green spaces and parks, and your non-motorized urban transport. Next, which among the following initiatives have been launched by SIDBI to improve the accessibility of credit and hand-holding services to MSMEs? So when you talk about for the SIDB, we have which portal the SIDB has launched? Udyami Mitra portal, MSME Sambandh, Sfurti or Aspire? Right answer is Udyami Mitra portal only, option A. You will find that this portal was launched in 2017, and ultimately the target was that whosoever wants to start their own business and they are lacking any expertise, they can directly ask for financial help and expert guidance via the Udyami Mitra portal. Then we have one important scheme, PM Vishwakarma scheme, which was launched in 2023, and this was asked in November 2025. So it is to provide the comprehensive support to traditional artisans who are working with hand, fine manual, no machineries involved. So there are 18 family-based traditional trades which the government has identified, and they lie in the unorganized sector. He or she must be the above age of 18 years, that you have to remember the eligibility criteria, and you should not be availing any loans under the PMEGP, Mudra, PM Swanidhi or any other such related scheme in the past 5 years. Only one member per family can take the loan from can take the benefits of the PM Vishwakarma scheme. And what is the loan amount? So initially you will be given 1 lakh, and after that it will be in having some additional amount also if you repay the first tranche in the limited time period, whatever was there in the repayment schedule. You are then eligible for the additional 2 lakh also. So cumulative amount comes out to be 3 lakh. The maximum amount is 3 lakhs you can avail under the PM Vishwakarma scheme. Apart from that, PM Swanidhi is also very, very important. So Swanidhi initially during the COVID, it was for street vendors, and ultimately the amount was 10,000 during COVID. But now gradually it has been increased. For the first tranche, up to 15,000 is the loan amount. Second tranche, up to 25,000 is the loan amount. Third tranche, up to 50,000. So what you have to remember, what is the minimum amount? 15,000. Maximum amount is 50,000. So here you will find that the loan tenure for the first tranche is 12 months, then 18 months for second, and for third tranche it is 36 months. Apart from that, you must be having the age limit in your mind. So minimum 18 years should be your age limit, the minimum age, and no upper age limit as such is there. Plus Swanidhi beneficiaries, they will be eligible for one credit card, which is directly linked with the RuPay, and it will be available as an additional facility for you if you have successfully repaid the second tranche. If you have successfully repaid this 25,000 loan amount, you will be getting one complimentary credit card with a limit of 10,000, and gradually you can increase the limit to 30,000 also, and the card is valid for a time period of 5 years. Okay, fine. SCOMET policy is simple. Let me just see. SCOMET policy stands for your special chemicals, organisms, materials, equipments, and technologies. So what we are trying to do, uh, the Indian government wanted that we should have the export potential in our country itself, and we should establish a norm via the Make in India that we will be manufacturing some type of materials and equipment which will be exporting, like specialty steel. Then comes some type of special chemicals which we will be exporting, and there will be some import and export of some microorganisms utilized for your medicinal requirement, fine. And some technologies we will be developing, like right now AI is there, machine learning, etc. Okay, all these clubbed together, they are called as SCOMET policy, SCOMET. Right? Okay, next we have with us this one. Suppose for a given financial year, nominal GDP is given to be 200 lakh crore, real GDP is given to be 160 lakh crore. What is the value of GDP deflator for that year? GDP deflator, simply nominal by gross or nominal by real. Right? Nominal GDP divided by real GDP, you will get the GDP deflator. What is the right answer then? 200 divided by 160. The correct answer comes out to be 5 by 4. So this will be what? 1, 2, 5. Because you have to multiply it by 100 also. 125. Yes, C is the right answer. Yes, C is correct. Primary objective of Startup India, it is to exclusively focus on technology sector. No, we will be having multiple sectors. To provide financial assistance specifically to women entrepreneurs and those belonging to SC/ST communities. No, we will be talking about the Stand Up India here, not the Startup India. Fine, this is for the Stand Up India. This is wrong. To foster innovation, promote long-term economic growth, and create large-scale employment opportunities across the various sectors in the cities. Yes, various sectors and various cities. That will be the correct answer. C is right here. Okay, C is correct. Yes, good. Next, Camel's rating system is used to evaluate the financial condition and performance of the banks. What does L stands in the Camels? L stands for what? Startup India, simply you are doing what? You will be starting off with the metro cities, fine. In all the sectors, not only in technology, you will be participating for the agriculture sector, for the other services also, but from the metro cities. And gradually you will be moving towards spreading your ultimate businesses to the rural areas also. So from metro to tier 1, tier 2, tier 3, semi-urban areas, rural areas like that. And that is the core agenda of your Startup India. Yes, union budget, there you will find that the formulas are confusing, but when you talk about the formulas which we have to remember, they are fairly simple, right? Camels, L stands for liquidity, C for capital adequacy, A for asset quality, M for management quality, E for earnings, L for liquidity, and S for sensitivity to market risk. Now, the famous artist Mrigank released a new collection of abstract sculptures. He initially priced them at rupees 2 lakh and sales were steady. Later on, advice of his gallery, he raised the price of the remaining pieces to rupees 4 lakh. Surprisingly, the waiting list for the sculptures grew immediately, with art critics and wealth collectors citing the higher price as proof of their exceptional artistic merit and exclusivity. This phenomena, where the demand for good increases with its price due to its higher social status value, is best described as the example of what kind of economic effect. We are talking about what? The price of an already expensive product has risen. So we are talking about which type of phenomena? Substitution effect? No. Substitution effect talks about the law of demand, not the exception to law of demand. Conspicuous consumption? Yes. The Veblen commodities. B is the right answer. Giffen effect is for the inferior goods. None of these. No. B is the right answer. Yes, B is correct. Okay, ISLM framework, if the Indian government increases its spending on infra projects, which of the following is most likely to occur? So this question I want everybody to answer, because we have seen the ISLM matrix just 30 minutes back. So when the government increases the spending, it means fiscal expansion. And since it is government, we are talking about government. So IS curve will shift towards right. And what about your rate of interest? That will rise. What about the output? That will also rise. Everyone should answer this question. What is the right answer then? The IS curve will shift towards left? No. IS curve will shift towards right? Yes. It will shift towards right. But LM curve? No. LM curve is not involved. So A and B are gone. IS curve will shift towards right. Yes, this is the right answer. LM curve is not there at all. C is the right answer. Correct? Good. C is correct. Fine. Now let's just talk about the CSR obligation numerical. As per the section 135 of Companies Act 2013, every company meeting the CSR criteria shall spend at least 2% of its average net profits of the 3 immediately preceding financial years on CSR. Right? Given below are the annual profits in rupees lakhs for 4 companies. And when we talk about these companies, they are meeting the CSR norms. Fine, they have to follow the CSR norms. So calculate their CSR obligations for the current year and select most appropriate answer from the options given below. What will be the right answer here? So first of all, you have to take the average. Fine, these are the profits for year 1, year 2, year 3. Step 1 will be to have the average. So 150 plus 200, we have what, 350. 350 plus 250 will be 600. That is the addition. Now average divided by 3, because 3 years are there. You will get what, 200. Fine, 200 as the profit. Fine, this is your average profit for the last 3 years, and this 200 will determine your CSR obligation also. How? 2% of this 200 is your CSR obligation for the company A. 2% of 200 will be what? 2 divided by 100 multiply by 200. That will give you what? 4. Right? Okay, so 4 lakh, because the number is in lakhs. 4 lakhs is the obligation for your company A. That is the obligation for your company A. Similarly, for your company B, C, and D, we will be calculating. So let's just see the company D first. Fine, it seems fairly simple calculation. So 100 minus 100, this will cancel out. We are left with minus 200. So there is no profit. No profit means no CSR obligation. So for D, the obligation will be nil. Right. Then we have B and C here. For the year 1 and year 2 and year 3, just you have to club them. 350 plus 400 plus 300. What will be the answer here? 650 plus 400, that is 1050 divided by 3. Okay. Then we have 200 minus 100, that will be 100 plus 300. So 100 plus 300 is 400 divided by 3. Simply you can use the calculator also for the accurate numbers. 1050 divided by 3. Fine. So 350 will be there. And for this 400 divided by 3, 400 divided by 3, you have 133.33. 133.33. So for this particular company, 2% will be what? 2% of your 350. It will be what? 2 divided by 100, right? So this will cancel out. 70 divided by 10. It will be 7 lakh. Fine. So for the B, it will be 7 lakh. Then we have for C, 133.33. Its 2% will be what? Multiply it by 2 divided by 100. It comes out to be 2.66. 2.667, something like that. Okay. So what is the right answer? We have 4 lakh, 7 lakh, 2.66 and nil. Correct answer comes out to be what? Everybody. Correct answer is B. Good. Good. B is the right answer. Right? B is correct. So these are the calculations for your reference. You can find them in the PDF, or else if you are watching the recorded video, you can pause also. Okay, which term is commonly used to describe the speculative short-term capital like foreign institutional investment (FII) that is prone to quick withdrawal and can destabilize a country's financial markets? Whether it is the fixed capital, patient money, venture capital, or hot money. We are talking about the hot money. FIIs, they change their market very quickly, and that makes your money very much volatile. The volatility of the money is quite high. That's the reason why we call this as hot money. D is correct. Fine, and I think every year they ask this hot money concept for zero point 0.5 marker. How often is the SDR currency basket typically reviewed to ensure it reflects the relative importance of global currencies? So how often? SDR is reviewed after every 5 years or earlier? Yes, you have seen that. C is the correct answer. Okay, 5 years or earlier. Currencies, let's just revise again. US dollar, euro, yuan, yen, and pound. Yuan is for China, yen for Japan, pound sterling UK, euro for the eurozone, and US dollar for USA. How many distinct SDGs were established by the United Nations to be achieved by 2030? So SDGs, how many? 17 SDGs, 169 targets. Correct answer is option C. Yes, yes, C is correct. Good. Under the Tarun Plus category of Mudra loan, what is the loan amount range offered? So Tarun Plus, a newly introduced category, here 10 to 20 lakh. Fine. So correct answer comes out to be above 10 lakh up to 20 lakh. D is the right answer. Earlier, the category was Tarun. Fine. Maximum amount was 10 lakh, but Tarun Plus has been introduced for covering the loans above 10 lakh to up to 20 lakh. Shishu and Kishore, Shishu up to 50,000, Kishore above 50,000 up to 5 lakh. Okay, SDF we have already seen, I think. Yes, SDF question we have done. No, we have not done the SDF question. SDF we have done SDR. Yes. Which of the following statements best describe the key difference between the SDF and reverse repo rate in India's monetary policy framework? Yes, yes, Chinese currency, renminbi or yuan. Yuan is the another name for the Chinese currency only, or for that matter, renminbi you can also call it. Yes, so the right answer is your option B only. SDF is unsecured facility for the banks to park excess liquidity, and while your reverse repo rate is a secured facility where the banks park the funds with the RBI using the government security as collateral. So SDF and reverse repo, what is the difference? Collateral is not required in your SDF, but it is required in reverse repo. Purpose is same, to absorb the excess liquidity. Availability, it is available to all the LAF participants, and your reverse repo is available all the banks. When you talk about the interest rate, historically you will find that reverse repo rate has been given more importance earlier, but now it is not at all being revised by the RBI. So since COVID only once it has been revised, now it stands at 3.35%, whereas SDF is regularly revised on the basis of a repo rate, and you just subtract 0.25 from the repo rate, you will get the SDF. Like right now, repo is 5.25, subtract 0.25, you will get SDF as 5%. Okay. Yes, yes, long term. Now, NK Singh committee was formed to review the FRBM Act in India. Which of the following was the key recommendation of this committee? So, key recommendation to increase the fiscal deficit target to 5%? No. Indefinitely? No. 5%? No. Not at all possible. To completely abolish all the fiscal deficit targets under the FRBM Act? Again, not. fiscal deficit target should not be abolished rather than complied with. To introduce debt to GDP ratio target along with the gradual reduction of your fiscal deficit. Gradually reduce the fiscal deficit. Yes, C is the correct answer. So correct answer is your option C. Fine. Match the following in relation to the topic journey of Indian industry. So Indian industry started its genesis with phase 1951. So it was the period of industrial foundation. One is with A. Then comes your fall period 65 to 1980. The B period will be there. Then comes your phase 1980 to 1991, which is for the recovery. So C is here. Lastly, phase 1991 onwards, you will find what? The post reform period, that is D. So A, C, B, D. A, C, B, D. A is the right answer. A is correct. Okay, A is the right answer here. Now, the Parvatmala scheme announced in Union Budget 2022-23 primarily focuses on what? Developing the high-speed rail networks in the mountainous region, improving the road connectivity in hilly areas through large-scale highway projects, enhancing the connectivity and promoting the tourism in the hilly areas through the development of ropeways, or establishing new airports and heliports to improve the transportation in mountainous terrains. What is the right answer? Promoting the tourism. Along with that, we are trying to develop the ropeways, enhancing the connectivity. C is the right answer. According to the National Economic Policy NEP 2020, what is the target year for achieving the universalization of education from early childhood care and education to secondary education? Fine. We are talking about ECCE. 2025, 2030, 2035 or 2040. Correct answer stands at 2030 for your ECCE. Fine. So universalization of education from ECCE to secondary education by 2030. Then attaining the foundational learning and numeracy skills through the national mission by 2025. 100% gross enrollment ratio in your preschool to secondary level by 2030. After your secondary level, the gross enrollment ratio must be 50% in higher education by 2035. So the target years are important for our examination. Target years they can ask. Fine. Which of the following statements correctly matches an economist with the core concept of his definition of economics? So we have seen that Alfred Marshall is for the welfare definition, Adam Smith is for the wealth definition, Lionel Robbins is for the scarcity definition, right? So accordingly, your right answer comes out to be option B, Alfred Marshall associated with welfare, viewing the economics as study of human action in relation to the material well-being. Fine. Adam Smith is concerned with your scarcity definition. No, it was Lionel Robbins. Robbins is associated with wealth definition. No, it was Adam Smith. J.M. Keynes associated with welfare definition. No, J.M. Keynes was not there defining the economics. Fine. Macroeconomics, he gave the input. Fine. According to the section 45 ZB of the RBI Act 1934, what is the primary purpose of MPC? Primary purpose. Purpose is to regulate the banking sector in India, manage the government's fiscal deficit, maintain the price stability while keeping in mind the growth objective, or advise the RBI on the matters of forex reserves. Right answer, section 45 ZB, we have to maintain the price stability. That is the obligation, right? And the objective is growth. Then by what year was the CRR brought down to 4.1% from 15%? 4.1% from 15%. 97, 1991, 2003 or 1995? Correct answer is 2003. Yes. 2003 it was your CRR, and in 1997 you will find that SLR was reduced. So for our exam, what we have to remember? We have to remember the policy rates which are in front of you. So policy repo rate 5.25%, SDF is 5%, marginal standing facility is 5.5%, bank rate is 5.5%, fixed reverse repo is 3.5%. So we have LAF, liquidity adjustment framework, or the facility, where the base is your repo rate, fine, which stands at 5.25 right now currently. This is the liquidity, you can say, overall band. And when we talk about adding in the repo rate 0.25, once you add 0.25 in repo rate, you arrive at the marginal standing facility, that is MSF. Right? So it stands at what? 5.25 plus 0.5. You will get 5.50 as MSF rate. And if you subtract 0.25 here in the repo rate, you subtract 0.25%, you will get what? You will receive a direct number for the SDF, which is 5.25 minus 2 point, minus 0.25, you will get 5% as the SDF, right? And that is what is written here also, these three values. Okay, this is what your liquidity adjustment framework. Based on this only, the RBI decides that how the liquidity must function in the economy. Okay. Then we have reserves ratio, reserve ratios, SCRR and SLR, 3% and 18%. Fine. So yes, now let's have a break. If you want any kind of break, we can have now, because after that we'll be moving towards the next modules. Okay, let's have a short break, 10-15 minutes. You guys tell me, 10 minutes, 15 minutes, whatever the time is suitable. 10 minutes, 10 minutes. Okay, done. Okay, 15 minutes. We'll meet at 8:45 then. Fine. So we'll be meeting at 8:45. Fine.
So let's begin then. Right. I can see that the participants have joined now. Everyone, let's start. So when we talk about the module A and B, we have covered most of the important topics. And when we talk about the remaining portion of this video, we'll be dedicating towards the module C and D. But before that, some formulas are there which we must remember. So let's try to solve some question based on the formulas also. So let's have a look to this. Yes. M1, M2, M3, M4. Let's just try to solve this question based on the measure of money supply. This is just a case, fine. So you can expect such type of questions in the examination where some case will be there. Based on that, theory will be tested plus the formulas as well. Okay. So RBI uses different measures to monitor the total stock of money in the economy. These measures labeled M1 through M4 are classified based on their liquidity, how easily they can be spent, and whether they are considered narrow or broad money. An economist is analyzing the financial health of a specific region. He gathers the following data from the local banking and post office systems. So this is the data with us. We have currency with the public, we have demand deposit with the banks, other deposits with the RBI, saving deposits with the post offices. Then we have the time deposit, the fixed deposit as we call it, with the banks and NSC as well. So all these things are mentioned. Currency with the public, 5,000 is there. So we will be having what? M1 from the currency with public plus demand deposit plus other deposit. This will give us M1 just for your uh, revision. Then we have M2. M2 will be including the saving deposits with the post office. So just add this number to M1, you will get the M2. Then in M1, if we add the time deposit, we will get M3. And lastly, for the total post office deposit, simply you have to add M3 in this number to get the M4. Okay. That's how we will be calculating each and every component. Now let's just see the question. What is the value of M3? So M3, how you can calculate? Simply by adding M1 to 8,000. So M1 is what? 9,500. This is 9,500 plus 8,000. The correct answer comes out to be 17,500. A is the correct answer. M1 is 9,500, M2 is 10700, 17,500, and good, good, Danish. Excellent job. Next, consider the following statements. M1 excludes all the post office deposits. Yes, because post office deposits are there only in 2 and 4, M2 and M4, right? M2 is always greater than M2. M2 is always greater than M3 in a given data. See, M2 is what? M2 is having some component which is not there in M3 and vice versa also. Like M2 is having M1 which is there in M3 also, right? Both are having this thing in common. But what about the uncommon part? M2 has the post office savings deposit and M3 has the time deposit. So you cannot equate these two particular measure of money supply, and you cannot say that M2 is always greater than M3, or for that matter M3 will always be greater than M2 because of the difference of values. So second statement is wrong. M3 does not include any post office deposit. So M3 is not including any post office deposit. That is absolutely correct. Then M4 includes components that are less liquid than M1. Always remember, from M1 as you move downwards. So from M1 you move to M2, M3 and then M4, liquidity will decrease, right? Decrease liquidity you will be finding. So what is the right answer? Correct answer is option B, 1, 3 and 4 only. Second is wrong. If 2000 crore is shifted from currency with public to demand deposits, what will be the impact? So currency with public has been shifted to demand deposit. So currency with public plus demand deposit plus other deposits with RBI, we have the M1. And this M1 will be there in M2 also and M3 also, right? So keep that thing in mind. M1 increases when we talk about the currency has shifted from public currency with public to demand deposits. Whether M1 will increase? No, it is moving within the M1 only. So this is wrong. It will decrease? No, it will remain unchanged. Yes, C is the right answer. Okay, C is correct. Then, which statement is most accurate? All the components of M2 they are included in M3. So M2 has what? M2 is having M1 plus the savings part of your post office organization. So only M1 is common between M2 and M3, right? M1 plus time deposit. So all the components of M2 are included in M3? No. This post office component is not included in M3. M3 is independent of M1. M3 is not independent of M1. It has a very integral relationship with M1. M4 is including the saving deposits twice. No, it is having the saving deposit from the M2 and overall deposit is there in the last, the final one. Right? Not having the saving deposit from M2, right? We are not calculating M3 based on M2. M4 is based on what? M3 plus the total post office savings, fine. Whatever the total deposits are there in the post office. So M4 includes saving deposits twice? No, only once in this total. So this is also wrong. M2 includes component not present in M3. Absolutely right. There is post office which is not included in M3. D is the right answer. Yes, good, good. M1 is the most liquid measure of money. Yes, when you talk about liquidity, it excludes the time deposits and post office deposits, which actually makes your liquidity very much less. So the right answer will be what? Both A and R are correct, and R indeed explains the assertion. So correct answer is option A. Fine. So I hope that this particular table you will memorize, revise again and again all the permutation and combination, whether it is based on the theoretical questions or for that matter calculations, everything you will be able to do. Now let's move on to the lease concept. Yes, back to lease, because these topics are very, very important. Fine. In module C, you will find good questions from NBFCs, from your banking laws, and for your module D, lease is important. We have some topics like your RBI schemes, very, very important. Your retail direct account is very, very important for this particular examination. Then the pension schemes are important. So all these things we'll be doing now. Which of the following statements best explains how sale and lease back differs from direct lease and leverage lease? Sale and lease back, you are selling and then leasing it back, right? So sale and lease back, the lessee acquires a new asset after the lease period? No, not at all. Sale and lease back, the lessee already the owner of the asset. Yes, you are already the owner. You are selling it to some other party and then leasing it back for your use. So B is the right answer. Yes, B is correct. Fine. So lessor directly buys asset and leases it to the lessee. That is your direct lease. Leverage lease, three parties are involved: lessor, lessee, and lender. And in the leverage lease, what will happen? You will have to give the lease. Fine, you will be purchasing, let's suppose a company buys the aircraft partly using the bank loan and then leases it. So using the lease rental, you are doing what? Fulfilling the loan obligation also. So three parties are there. One is having the ownership right, but right now the asset is on the loan, and the second party will be your lessee who is provided with that particular asset to use. Only right to use will be there. Third party will be the bank which has given the loan. Sale and lease back, owner sells the asset and then leases it back. Okay, I think last class we have seen these questions. Fine. In your class, the revision class, we have seen these questions. Commercial paper, yes, CPs we have seen. This also we have seen. Investment banking. Yes, these questions we have to see now. Merchant banking we have seen. Yes, from here we will start. Okay, so all of you who were not present in the last session, the yesterday morning session, I would highly recommend that watch that video also, because we have covered there also good number of questions. Fine. It was more than 3 hours class. Right. Yes, yes, try to answer. Yes, so what is the right answer here? Mr. Khanna owns a warehouse worth rupees 50 lakh, insures the property against the fire for 40 lakhs. A short circuit causes the fire that results in a partial loss with the damage assessed at 10 lakh. Assuming the policy contains average clause, what is the maximum amount of compensation which you will get? So 40 divided by 50 multiplied by 10. What is the right answer here? Correct answer comes out to be 8 lakh. B is the right answer. Right. So sum insured divided by the value of property multiplied by the actual loss. 40 lakh divided by 50 lakh multiplied by 10 lakh. 8 lakh is the correct answer. Next question. Suppose the central bank of a country sets the sets the cash reserve ratio CRR at 8%. Current reserve money M naught is estimated as 50 lakh crore. Calculate the potential broad money. So M3 by M naught will be equal to what? Will be equal to your money multiplier, which is also equal to the reciprocal of your reserve ratio. Fine. So M3 will be equal to what then? Which you have to calculate M3. It will be M naught by CRR. M naught is given as what? 50 lakh crore. 50 lakh crore is given, divided by 1 divided by CRR. So 8% means 0.8. Fine. So what will be the right answer when you talk about 0.8 or 8 by 100? If we call it as, it will be 12. 8 by 100, 25, 25 divided by 2, right? 12.5, 12.5 into 50, 625, right? 625. B is the right answer, right? Yes, B is correct. But so reserve ratio, you have to calculate 0.08 it will be. So you have to remember one thing, that convert the CRR to the decimal. You have to remove the percentage always. Then calculate the money multiplier, 1 divided by the reserve ratio. We get the right answer for the money multiplier as 12 point. Ultimately, yes, money multiplier will come out to be 12.5. Simply you have to multiply this number with your 0.08, which 0.08, you have the money multiplier. Now you have to simply multiply it with the reserve money and you will get the broad money, M3. Fine. What is the personal income here? So personal income, simply it is in the GDP chapter, right? Chapter of GDP. There you will find one formula for the personal income, and it is derived from the private income. Fine. From private income, you have to subtract various things. So supposingly the private income is 8,000 billion rupees. During the same accounting year, the following values are recorded. Undistributed profits of enterprises is 700 billion. corporate profits 1200 billion, retained earnings of foreign companies 300 billion, and taxes paid by the individual and household, they are 600 billion. What will be the right answer? Personal income. You have to simply subtract it, right? So 7, 1000, 22, 28. So 28, it means what? 52, right? 52 billion will be the right answer. 5200 billion will be correct. A is right answer. Yes, everyone. 8000 minus 700 minus 1200 minus 300 minus 600. This comes out to be what? All the cumulative subtraction which you have to. This was 2800, right? 2800 billion. A is the correct answer. Private income minus your undistributed profit minus corporate profit minus retained earnings of your foreign companies minus taxes. And that will give you the personal income. It is the actually received by the individuals or the households in a country. Now, when you talk about the compensation amount here in this case, just now we have seen one question. Try to answer this question in 3 or 4 seconds. You have what? Ultimately, 20 lakh is the property value, 14 lakh is the sum insured, and damage is 9 lakh. What will be the right answer for compensation amount? For compensation amount, everybody. The formula we have seen, right? Already seen the formula. Yes, yes, good. B is the right answer, 6.30. Simply insured value divided by the total property value multiplied by the actual loss. Now, let's shift our focus towards yuan. Try to answer this question. When you talk about the universal account number as implemented by EPFO, what are the important points? So yuan is unique 12-digit number assigned to the employee. Yes, you have to give me the incorrect statement. So this is the correct statement. Yuan program was launched in October 2014 under the Pandit Deen Dayal Upadhyay Shramav Jayate कार्यक्रम. Exactly. The employee must open new EPF account every time they change their employer, resulting in new yuan. This is the incorrect statement, right? Every time you need not to open a new EPF account. C is the right answer. So yuan is what? 12-digit number assigned to the employee, and it enables to the linking of multiple EPF accounts allotted to a single member. Launched in October 2014 as part of Pandit Deen Dayal Upadhyay Shramav Jayante कार्यक्रम. Okay, now let's just talk about this question where they have already asked this question twice in May 2025 itself, twice. In once in the first shift, then in the third shift also. So what will be the right answer here? The government nationalized 14 private banks with deposits over 50 crore on 19th July to 1969, and 6 more with deposits exceeding dash. That is how many crore? 200 crore is the right answer. 200 crore on 16th April 1980. Yes, yes, B is the right answer. Dash was taken over by Punjab National Bank in 1993. Which bank? We are talking about the new Bank of India. A is the right answer. For setting up the universal banks in private sector space, bank shares should be listed on the stock exchange in dash for the business commencement. So listed on the stock exchange in how many years from the commencement of business when we are talking about the private sector banks? 5 years, 7 years, 8 year or 6 years? Yes. So the right answer is 6 years. D is the correct answer. Stock exchange. How much was the minimum deposit of banks that were nationalized in 1969? Just now we have seen 200 crore was for 1980 and 50 crore was for your 1969. B is the right answer. B is correct. Which among the following committees has recommended the establishment of universal banks? See these questions, whatever we are seeing here, they will be asked for zero point 0.5 marker from module C. In module C, maximum questions you will find they are of this nature only. Narsimham Committee 1, 2, the Hote Committee or Sodhani Committee. So when we talk about the universal banks, it was Narsimham Committee 2. The Hote and Sodhani Committee, they were ultimately the committees for the capital account liberalization, fine, reforms in the India's financial sector. According to the revised qualifying asset criteria, what is the maximum limit on microfinance loans for NBFCs that are not classified as NBFC MFI? So when we talk about the qualifying criteria for those NBFCs that are qualified for NBFC MFI, that is 75%. Not classified as these, what will be the right answer? 75, 50, 25 or 10? Correct answer is option C, that is 25%. Okay, everyone? Yes, good, good. RBI's regulatory framework for MFI, what all you have to remember. First of all, the limit, fine, limit on the loan repayment obligation. So it shall be subject to a limit of 50% of your monthly household income. Fine, the income which a household is earning for the microfinance loans, your obligation should not exceed 50% of the monthly household income. Means the EMI cannot exceed this number. Qualifying asset criteria, 75% of your assets must go towards the lending. Yeah, that is your microfinance loans in case of your NBFC MFIs and NBFCs other than microfinance institutions. You should be having the qualifying criteria as 25%. Earlier it was 10%. It has been revised upwards to 25%. Fine. The recommendations to link NBFC deposit acceptance to net owned fund NOF was made by which group in 1975? So when we talk about the group, very important group, which ultimately gave the uh, path for the regulation of NBFCs. Fine. Narsimham Committee, James S. Raj Study Group, Urjit Patel Committee or Khan Working Group. We are talking about the James S. Raj Study Group. Option B is the right answer. So here you can see in 1970s, RBI directed that hire purchase and leasing company could accept deposits up to NOF. One net on fund will be there, their own net on fund. As per the recommendations, you will find James S. Raj Study Group was the ultimate committee or for that matter study group which recommended that yes, this reform must be made. And after this reform was made, NBFCs started to push more towards your businesses, more towards the leasing businesses, and mushrooming of NBFCs happened. Ultimately, the RBI had to intervene for the regulation of those NBFCs. Right. Now let's talk about the match the following financial institutions with their respective regulatory authorities. Type of institutions are given: housing finance institutions, stock broking companies, insurance companies, chit fund companies, and regulatory authorities are given here: IRDAI, National Housing Bank, state government, or SEBI. So what will be the right answer? Housing finance institutions directly linked to NHB. Fine, they will be regulated by NHB. Stock broking company, SEBI. Insurance companies, IRDAI. Chit fund company, your state government. What will be the right answer? Correct answer is option A, A2, B4, C1, D3. And here is a quick update for all of you. Companies, when we talk about there are various companies who are registered under Section 3 of the Companies Act 1956. All these are having the registration under the Companies Act. So NBFC is registered with RBI. You will have the regulation, supervision, surveillance enforced under the RBI. Then NBFC is regulated by other regulators. For housing finance, we have National Housing Bank, Merchant Banking Company, SEBI is there. Then Nidhi companies, mutual benefit companies, we have MCA. Chit fund companies, state government. Insurance companies, IRDAI is there. Non-banking, non-financial company. Non-banking, non-financial company. Fine. We are not talking about NBFCs. They are the non-banking company but financial. But we are talking here about non-banking, non-financial companies. They will be regulated by MCA, Ministry of Corporate Affairs. Enforcement agency will be state governments. Yes, good. What is the permitted tenure for your public deposits accepted by deposit taking NBFC? So public deposit, the permitted tenure, maximum 60 months, minimum 12 months. So right answer comes out to be minimum 12 months and maximum 60 months. B is the right answer here. Simple questions. See, in module C, you will find direct questions. Nothing like your module B, which is having complicated language, twisted language, or for that matter, module D, right? So deposit taking NBFCs, NBFCDs, here you will find that the NBFCs are allowed to accept and renew the public deposits for a minimum period of 12 months, maximum period of 60 months. NBFCs cannot offer the interest rates which are higher than the ceiling rate prescribed by the RBI, and presently it is 12.5%. Also, NBFCs cannot offer gifts or incentives, and the deposits with NBFCs are not insured. Fine. All these points are very, very important. These highlighted points, these bold letters are very important for the exam. Under which section of Banking Regulation Act 1949 is a banking company prohibited from granting the loans or advances against security of its own share? Section 19, 20, 22, or 23? What is correct here? So own share, advances against the security of its own shares. It will be your section 20. Fine. B is the right answer. 19 talks about the restriction on the subsidiaries, and 20 talks about restriction on loans and advances. Specifically, banks cannot grant the loans against their own shares. Section 21, RBI's power to control the advances. 22, licensing we have. Ultimately, no company can carry the banking without the license from RBI. Section 23, prior permission from RBI is required to open new branches or transfer the existing ones. Prior permission. Yes, yes, good. B is the right answer. Then which of the following conditions must be met for non-banking financial company NBFC to be classified as core investment company CIC? Core investment company. So it must hold at least 75% of the total asset in form of investment in the group companies. Its investment in equity shares of group companies must constitute not less than 60%. Or for that matter, it is permitted to trade regularly investment in group companies to maximize profit, or the minimum asset size required for such company is 50 crore. Fine. Eligibility criteria for your CIC. Which of these four statements you think that are related with CIC? Option B, investment in equity shares of your group companies must contribute not less than 60% of the total asset. Fine. That is the point which we have to remember. Your core investment companies, it should not hold less than 90% of asset in the form of investments in equity share, preference share, debt, and loan in group companies. And when we talk about the 60% criteria, investment in equity shares, uh, yes, equity shares in group companies not less than 60% of the total assets. So 60% is the threshold when we talk about the investment in equity shares. Then what is the minimum percentage of total asset that an infrastructure finance company IFC must deploy in infrastructure loans? Infrastructure loans, direct answer will be what? 50%, 60%, 75%, or 85%? What is the right answer here? So yes, the correct answer is your option C, 75%. Infrastructure loan. Always remember, infrastructure finance company is the non-banking finance company which deploys at least 75% of the asset in the infrastructure loans. Also, additionally, NOF you have to remember 300 crore and has the minimum credit rating of A or equivalent, and also your capital to risk weighted asset ratio of 15%. Next, what are the minimum asset and income criteria for an non-deposit taking entity to be classified as an NBFC factor? So whether it is 75 for the asset and the income, asset should be greater than equal to 50, income should be greater than equal to 50. Asset greater than 50, income less than 50. Asset greater than equal to 25, income greater than equal to 75. 25. What is the right answer? It is 50-50. Always remember F for factor and F for 50-50. Like that you can remember. Okay, B is the right answer. Fine. NBFC factors, at least 50% of its total asset should be there, and then only it will be the factors, right? 50% in the factoring business. And when we talk about income, so income derived from the factoring business should not be less than 50% of your gross income. Then only you will be termed as NBFC factors. Fine. Which of the following entities is not listed as IRDAI approved insurance repository? So IRDAI approved insurance repository, which all are the IRDAI approved insurance repositories. We have NSDL as the approved one, CAMS also, CARVI also. LIC is not an IRDAI approved insurance repository, right? So C is the right answer. What else? So the other approved repositories are NSDL, Central Insurance Repository, SHCIL, CARVI Insurance Repository, and CAMS Repository, right? As per the section 38, who has the exclusive power to order and direct the winding up of LIC? So LIC was formed with the initiation of government only, fine. So formation was by the government, and ultimately winding up will also be a part of government only, fine. Government only can decide. So Supreme Court of India, Board of Directors of LIC, central government or IRDAI. So the right answer is central government. Option C is correct. So LIC Act formed on 1st September 1956. Capital contribution 5 crore from the government of India. What are the objectives here? Objective simple: to conduct the business in spirit of trusteeship, need not to harm the investors' interest, to charge premium not higher than warranted by strict consideration to invest the funds for maximum yield for the policy holders. Like we say that the investors, the policy holders should get the maximum benefit. More important are these sections, section 37 and 38. 37 talks about central government guarantees for sums assured and bonuses declared under the LIC policies. This does not apply to the ULIP policies, right? Does not apply at all to the ULIP policy or section 37. When you talk about the guarantees, right? In ULIP, no sum is guaranteed, or for that matter, central government does not guarantee for your sum assured. Section 38 talks about LIC cannot be terminated by any law unless your central government orders and directs to be. So fine. Only central government can decide that how we are going to wind up the LIC. Okay. Now let's talk about the insurance account, e-insurance account. So person is allowed to open multiple e-insurance accounts with different IRDAI approved repositories. Fine. So repositories we have seen. Opening an e-insurance account is free of cost for the applicant. So it is free of cost, but multiple e-insurance accounts, no. One person, one account. So the right answer comes out to be what? One is incorrect and the statement 2 is correct. So one is incorrect, statement 2 is correct. D is the right answer, right? D is correct for this particular question. Yes, yes, good. E-insurance, what is happening here? What kind of account is this? It stores all the insurance policies in electronic form, giving easy online access. It can be opened with any IRDAI approved repository, but only one account per person is allowed. Each account has a unique ID and login credentials to access the policies. It is free of cost for all the applicants. Even if you are not having any kind of existing policies, still you can open the account. And when we talk about the existing paper policies, if you are holding, they must be converted into the DMAT form, fine, electronic form via submitting a service request. Policyholders can appoint an authorized representative to manage the case in case of your death or incapacity, and this authorized representative only has the access rights to those policies. Until and unless this authorized representative is a nominee or an assignee, then it's a different thing. But yes, if they are not nominee, not a particular legal heir, then you are only having the access rights. Okay, match the specific ease edition with its primary strategic theme as outlined in Public Sector Bank Reform Roadmap, PSB Manthan. Okay, so PSB Manthan started off this particular reform. Ease reforms were introduced in 2017's PSB Manthan. It was discussed, and by the next year we had the Ease 1.0. So with these additions, you have to match the primary themes. So Ease 1.0, Ease 2.0, 3.0, 4.0. 1.0 is matched with responsive and responsible banks, fine, PSBs. Then we have your Ease 2.0, which is matched with what? Whether it is your clean and smart banking, or for that matter, it is the smart tech enabled banking for aspiring India, right? Clean and smart banking. Then Ease 3.0, we are talking about what? The smart tech enabled banking for aspiring India. Is 4.0 tech enabled simplified and collaborative banking? The correct answer is option 1. Yes, this is correct. Okay, so C, D, B, A. Fine. C, D, B, and C, D, A, and B. Yes, A and B. C, D, A, and B. Yes. First is the right answer. Yes, yes, A is correct. Good. So quickly, let's just see the themes. Themes are important for our exam. E is 1.0 responsive and responsible PSBs, 2.0 clean and smart banking, 3.0 smart tech enabled banking for aspiring India. So RR, fine, responsive and responsible public sector banks, clean and smart banking, fine, clean. Let's just have it clean and smart banking. Smart tech enabled banking for aspiring India. Smart tech enabled banking for aspiring India. A. Then we have tech enabled, simplified, and collaborative banking. Tech enabled, smart tech enabled. So some themes will be same. It's only an upgradation to the previous version. So collaborative banking, you can say that is the more appropriate theme, which is distinguishing theme as compared to the previous versions. Is 5.0 enhanced digital experience, data driven, integrated, and inclusive banking. Is 6.0 talks about customer friendly banking enabled by modern capabilities. 7.0 economic development, customer delight, and resilient banking, ECR. Then we have Ease 8.0 driving innovation for business process reengineering, known as BPR, business process reengineering and customer excellence. So you will find that from the last three, that is your 6.0, 7.0, 8.0, the ease reforms have specific mention of customers. Like in 6.0, it is customer friendly banking, 7.0, customer delight, 8.0, it is customer excellence. Right? Okay, and the four key themes of RISE, of 8.0, it is RISE, fine, RISE. We have risk and resilience, innovation, socio-economic impact, which is for Vikasit Bharat, and then we have the excellence also, fine. So yes, these are the particular ideas which you have to keep in mind while reading the EASE 8.0. Chances are there they can ask EASE 8.0. Still, it is in its you can say implementation phase, because right now when we talk about the AI component, it is still ongoing. Rest is implemented, but one component is still there out in the open. So they can ask the question from your ease. So always remember ease is related with rise and your financial year 25-26. Fine. Which of the following sectors are prohibited for any investment under FDI? So one question from module A is also there here. Under FDI, prohibition is there. So development of townships you can do, yes. Telecom services you can provide, yes. Nidhi funds, no. Fine. You cannot invest under the FDI for your Nidhi funds. That will be the right answer. C is correct. Right. C is correct. What all are prohibited sectors then? Lottery business, which includes government, private lottery, online lotteries, gambling, betting, as well as casinos. Then chit fund nidhi companies, TDRs, transferable development rights. Then we have real estate business. But in real estate business, only speculative trading is prohibited. Otherwise, development of township, construction of residential, commercial premises, roads, bridges, they are allowed. Construction of farmhouses, that is also prohibited. Then we have manufacturing of cigar, charots, cigar rolls, cigarettes, all the tobacco substitutes, and activities that do are not open for your private sector investment. So if they are not open for private sector investment, how they will be open for your FDI? Fine. So what are those sectors? Atomic energy, railway operations. Fine. Railway core operations, not the railway infrastructure. Railway infrastructure, private players are doing that, the hoarding and all, beautification of the railway stations. But railway operations is still a public sector, you can say government's domain. Comet policy, what does O stands for? Organisms, right? This we have seen already. D is the right answer. Capital flight is one of the common term used while explaining the concept of what? Restriction on FDIs, FIIs, PPP, or all of the above. It is for your FIIs, fine, foreign institutional investors. Which of the following is not a characteristic of business cycle? So business cycle is non-pervasive in effect? No, it is pervasive in effect, right? It penetrates, it spreads across industries. So A is the right answer because not a characteristic was asked. A is correct. Okay, so boom, peak, then we have depression, recession, depression, draw, then again recovery, boom and peak. Four phases: boom, recession, depression, and recovery. Pervasive, business cycles are pervasive in their effects. They spread between the industries. They are not symmetrical. The up movement, this movement, see, this movement is up movement na? Here. This will take time. When government will have to push really hard to give you the boom, fine, to give the economy boom. And suddenly some pandemic will happen, some type of COVID-like situation will happen, and suddenly you find yourself in the negative, or for that matter downward movement. The economy is now having the negative growth or downward growth. So the time which it takes to move up, that is T1, is always greater than this T2. So it will take much more time to resurrect an economy, to give the boom to the economy. And it will take no time. Within few months, your economy will go into the recession, which happened while when the COVID happened. When the COVID hit the economy, we found ourselves in the recession phase. And then what happened once the recession was there? Ultimately, government intervened and the Atmanirbhar package was announced. Recovery path was followed. So low interest rate loans were there, and infusion of money was also there. Then phases of business cycle, when we talk about boom, recession, depression, and recovery, they are the four phases. Which among the following is our characteristic of boom of the business cycle? Accelerated and prolonged increase in demand. Yes, demand peaks to the levels that exceed sustainable output or production level, because everybody has everything. The income is high and the demand is also high. So one point will come when the production levels are not sufficient to meet these high demands. Then economy heats up and a demand supply lag becomes apparent. Yes, the supply will lag sometimes, and ultimately once the inflation kicks in, then supply is in abundance, now demand falls. So there will be a difference. So what is the right answer? Option C, 1, 2 and 3. All the statements are correct. So boom phase, economy heats up and the demand supply lag becomes apparent. Market forces mismatch is there, and the emergence of sellers market we see in the boom phase itself. Why? Because earlier the demand was high, supply was less. But once the suppliers start to produce more and more, and since at this situation, demand when the demand was high and supply was less, At this situation, the prices went high and these prices were not controlled in time. That's why they led to inflationary trend. And once the inflation kicks in, your income, your effective income is what? Effective income will look like a lesser money to have the purchases done. So we will find what? That the supply is now abundant. Right? After this particular phenomena, when the suppliers start to supply more, produce more, you will find that supply is more and demand is less. Ultimately, sellers market will prevail in this particular boom phase, but not always. Fine. Last, in the end, at the end, just before the peak and after the peak, you will find this phenomena. In which among the following phases of business cycle, once the economy reaches the peak and a downward tendency in the demand is observed, also inflation remains low or shows further signs of fall. So which type of phase are we talking about? Once the economy reaches the peak, downward tendency is there. Stagnant, recession, depression, or boom. The right answer is option B. We are talking about recession. Fine. Recession is there. That is why directly from the peak you are moving down. Right. Peak is when we are talking about boom phase. Then comes your recession. Okay, so recession phase, what are the major characteristics? Journal decline in demand, inflation remains low, employment falls, unemployment rises, and ultimately this phase is known as crisis. This is very, very important. They can directly ask you for point 0.5 marker, which of the following phases in business cycle is known as the crisis phase. Always remember, recession is the crisis phase. Okay, in which phases of business cycle the following characteristics are observed? Let me see the answers here. Everyone giving the answer? Yes. Good, good. That is good to know. See, all of you are giving the right answers also. Not only participating, but participating with the right answers. Good, good. Yes, I hope that the session is fine till now. Any tweak you want, any changes you want, that would let me know. Should we do something else or any kind of feedback? Fine. So, in which phases of business cycle the following characteristics are observed? Extremely low aggregate demand. So, when we talk about the demand is low, that happens in recession. But extremely low means we are entering or we have already entered into depression phase. Inflation is also comparatively lower in depression, and employment avenues they begin to close. No, not lower employment avenues. No, they begin to close only. No jobs, forcing the unemployment rate to rise rapidly. Correct? So 2, 3, and 1 they indicate what? That we are talking about the depression phase. Fine. Depression will be the correct answer. This is the keyword. Make or break phase. Fine. Make or break word. Extremely low aggregate demand. Demand is low in the recession, but extremely low and no jobs whatsoever. That is the characteristic of your depression phase. Yes, yes, good. B is the right answer. Extremely low aggregate demand, inflation is comparatively lower, employment avenue begins to close only. Right? You are not having any opportunity. To keep the business running, production houses resort to forced labor cuts and more retrenchment, more job losses will be there. So recession is just a tip of the iceberg. Fine, you can say that. Depression is much more deeper. Fine. Now let's talk about MCLR. But before that, I want you guys to give me one answer for the numerical. Uh, let's do the MCLR then. Uh, No, one numerical is there which we have to do because only one formula is left which we have not seen in this class. Yes, these we will be doing. There was one formula based question. Let me see that. Yes. So we have to discuss this one. SNA, starting from SNA, fine. GDP concepts. This is the very, you can say this is very important for our examination, the tomorrow's exam. SNA simply means what? System of National Accounts. Here you will find that we are talking only about one thing, that the global uniformity and comparability of data must be there. Comparability of which type of data? Data pertaining to the economic indicators. Fine. So this system has been developed by United Nations in 1947, first published in 1953. And why I'm saying this is important for us? Because recently we have undergone the change in the base year for your uh, various parameters, GDP. Then we have change in the CPI and your IIP. WPI still remains the same, but these three have a different base year now as compared to earlier. Earlier it was what, 2011-12. Now they have changed. So 2022-23, and when we talk about 2024, 24 is the base year for CPI, and 22-23 is now the base year for your IIP and the GDP. Okay, for WPI it still stands at 2011-12. So SNA is responsible for this. In India, though, okay, MOSPI and the government will be doing the work. But ultimately, why we are changing the numbers, why we are changing the base year, thanks to the system which has been established by United Nations. And that system is System of National Accounts, SNA. So nations are advised to prepare and report their national account statistics (NAS) in accordance with the accounting structure and framework outlined in the most recent edition, which is namely your 2008 SNA. So this is the latest one. Most probably by the mid of this year, by June or July, you will find that 2025 SNA has been implemented. But right now, for our exam till December, it is 2008 SNA. And prescribes, the SNA prescribes what? It prescribes that base year of the estimates including GDP, IIP, CPI may be revised at periodic interval. And this United Nations or particular, you can say the organization, overall organization is working for that SNA? No, only a specific department, which is Department of Economic and Social Affairs. And which division? Statistics division. A revision of base year to more recent year, that is what is the agenda of SNA, ultimate agenda. Complete review of the existing database and methodology employed. And that is the reason why we have seen that India's position, the global ranking in terms of GDP has fallen. Earlier, we were sitting at fourth position. Right? The estimates were saying that we will surpass Japan, but we were unable to surpass Japan thanks to what? Revision in the GDP base year. Now we are at the sixth position. For our exam, what we have to remember, we are at the fifth position, neither fourth nor sixth. For our exam, fifth position. You have to remember, fine. So a bit confusing, but that's how the entire data worked out to be. Fine. Expectation was we will be fourth. Ultimately, we landed up in the sixth spot. And for our exam, why we have to remember fifth? Because that was our ranking during the previous year. Implementing the international guidelines under the Inter-Secretariat Working Group on National Accounts. And this Inter-Secretariat Working Group on National Accounts is what? It is the ultimate group which is responsible for setting up the guidelines for SNA and the overall guidelines for base years. And this group comprises of European communities, Eurostat, that is your European Commission, we have IMF, OECD, United Nations, and World Bank. All the majority stakeholders will come in and they will sit and decide that what should be the SNA, for what should be the SNA framework for the latest edition. Like right now, it is SNA 2008. Earlier, it was SNA 1993, and soon we will look into the SNA 2025 as well. No impact on PPP, no impact. We are third, still we are third. Only this position you have to remember. Fine. Now let's talk about GDP. This is the formula which I wanted to convey to everyone because this is the only formula which is left. So value of the final goods and services produced, that is your ultimate definition of GDP within the geographical borders of an economy. So when I talk about GDP, what does gross stands for? Total, gross or total, one thing. Then domestic, a particular geographical area, or for that matter, domestic means a local area. And then we have product, which is a short form to production. So we are talking about what? Total production in a localized region. And what is this localized region? The country which we are talking about. And which country? For India, Indian GDP, we'll be talking about the India as a whole, India as a whole, and all those production which is ongoing within our country, that will decide the GDP. That's why we keep on saying that the production levels will decide the GDP. Higher the production levels, higher the GDP. Lower the production levels, lower the GDP. It does not differentiate between the owners and the owner. It does not differentiate between the owners of the factors of production. So land, labor, capital, all those will remain the same. What is the formula here? Formula is very, very important. So GDP is equal to, for the expenditure method we are talking about, C plus I plus G plus X minus M, where C is what? The ultimate consumption, right? I is the investors' money, or for that matter, you can say the businesses who are doing the expenditure. G is the expenditure done by the government. Then X minus M, X is the ultimate exporters' money. M is what? The importers' money, which is going out from our country. So everybody is doing what? They are doing some kind of expenditure. That's the reason why we call it as expenditure method of finding the GDP. C plus I plus G plus X minus M. This formula you should remember. Apart from that, what all formulas you should remember? We have the GDP at basic price. Simply GDP at factor cost. Add your taxes, subtract your subsidies, you will get the GDP at basic price. Market price, again same thing. Once you have the basic price, just add the product taxes, subtract the product subsidies. Then GNP, what is the formula for GNP? Once you have the formula for GDP, then you can easily calculate the GNP. How? So we have the GDP formula with us, and when you add in the GDP formula, net factor income from abroad, you get the gross national product. Fine. What is this net factor income from abroad? So let's just suppose that from India, there is some person who is residing in India, but not Indian. They are not Indian citizens. They are just working here and moving their remittance, they moving their money, sending the remittances to the family back in their native place. Right? And on the other hand, when we talk about some XYZ country, there is Dubai, let's suppose, the nearest one. So from Dubai, the funds are moving to India. Why? Because some Indian citizens are transferring the funds from Dubai to India for their families. Fine. So we will have that particular scenario here, which will talk about the net factor income from abroad. Fine. This is the net factor income from abroad, which you have to calculate. Fine. But for our examination, we need not to calculate NFIA. That will be given to us. Yes, this is live. NFIA, fine. So simply GNP is equal to what? GDP plus NFIA. And when we talk about the formula for NNP, simply net national product. Net national product is what? It will be the depreciation part will be subtracted from your GNP. Just subtract the depreciation from the gross, you will get the net. So GNP we have calculated from this formula, fine, NFIA formula. Now just subtract depreciation from here, you will get the net NN, net national product. Then comes your net domestic product. In net domestic product, what is important? So GDP is there, fine. You have the gross, subtract the depreciation from this, you will get the net domestic product. Fine. So what you have to remember, whenever from gross you have to calculate net, simply subtract depreciation from the gross. Then NDP at market price, how you will be calculating? Simple. NDP at market price is equal to what? The NDP at the base at your factor cost plus your indirect taxes minus the subsidies, plus taxes minus the subsidies. Personal income, we have seen one question also in the morning regarding the personal income. Simply private income minus undistributed profit minus corporate profit minus the retained earnings of foreign companies minus your taxes. Then we have PDI, your personal disposable income, the actual income which you can use for your expenditure. So you earn a particular income, which is personal income, subtract the taxes, the personal taxes, the direct taxes, and any fine, fee, receipt of the government. You have to subtract all, and then comes your disposable income, which you can actually use. Then we have private income formula. Private income is equal to what? From the national income, you have to subtract all the contribution which will go towards government corpus. So subtract the income from property, entrepreneurship, commercial, administrative expenses, enterprises, minus the savings of the non-departmental enterprise of the government. These will be subtracted. What will be added? Which will be actually added to the corporate's money. That is your private income. So add the interest on the national debt, add the net current transfers from the government providing funding to you, plus the current transfers from abroad. So these formulas are very, very important. Private income, you can skip also, but if we talk about personal income, try to remember that formula. In case of NDP, they can ask you direct question, and the most important formula stands at your GDP, C plus I plus G plus X minus M. This formula you should remember at all time. Okay, fine. So private income, let's just try to solve this question based on the private income formula. Suppose the national income of the country is 10,000 billion US dollar. The income from property and entrepreneurship, commercial and administrative enterprises accruing to the government is 800 billion. The savings of non-departmental enterprises of the government are 200 billion. So these two numbers will be subtracted from your national income. Why? Because they will go to the government. Fine. We are talking about calculating the private income here. So 800 and 200 subtract from 10,000, you will get 9,000 billion. Then the interest on national debt is 300 billion. Net current transfers from the government to household, they are 500 billion. Net current transfers from abroad, it is 100 billion. So when we talk about this particular number, national debt 300, your net current transfer from government 500, and your current transfer from abroad 100. You have to add these in the 9,000 because we have subtracted already. So 9,000 plus this is 800 plus 100, that is 900. Correct answer comes out to be 9,900. Right, 9,900. Divya, you should remember GDP formula. That is the most important one. Question will be asked from here, and one more formula, that is your factor cost. Right? Okay, factor cost and market price formula, the indirect taxes and subsidies one. These two formulas you must remember at any cost. Fine. Okay, for this question, the right answer is option A, 9,900 billion rupees. Okay. One more important formula related to GDP only. Circular flow model demonstrates that what are we looking into. So circular flow, simple. This particular model will tell you that the inflow of money is compensated by the outflow. So nothing remains within the economy. So GDP is calculated using only expenditure method, calculated only using income method, or total expenditure equals the total income in an economy. GDP is not related to income or expenditure. What is the correct answer? The right answer will be total expenditure equals the total income in an economy. Fine. Whatever is entering, that is being utilized, and some part will be debited also from the economy. So like investment goes in the economy, government spending, government infuses the money in the economy, exporters bring money in the economy. On the other hand, the importers, they send money to other countries. The government is spending money, but your taxes are also deducted. So the plus becomes the minus, and net will be zero. Investments, the investments will be there, but against the investments, we have some savings also. Fine. So that will go out. So all these will be what ultimately leading to a circular flow. What is coming in is going out as well. Why we have added? See, when we talk about private income, na, in the private income, the interest on the national debt, fine, whatever the interest on the national debt is, that will be utilized for the corporate players also, right? The corporate players will have some share from the interest on the national debt, And your net current transfers from the government will be transferring some money for the corporates, and current transfers from abroad also. You'll be raising funds from the abroad as well. That's why these three are added in the national income. Fine. Okay. Yes. Now let's just talk about the formula based question. This is the question which you should attempt. Everybody must attempt, because this type of question will be asked in the exam. Fine. So we'll ask you based on the GDP itself. So you have to calculate what here? GNP. So what is the right answer? When you talk about GNP, just now we have seen the formula GDP plus net factor income from abroad. Fine. So GDP, the formula is C plus I plus G plus X minus M. C is what? 5 lakh. I is 2.5 lakh crore, and G is 1.5 lakh crore. Simply you have to add these three. 5 plus 2.5, 7.5, 7.5 plus 1.5 gives you what? 9. So 9 lakh crore will be from here. After that, this X minus M, 1 lakh minus 1.2 lakh. So X minus M will be there. So it will be what? Minus 20,000 crore. And then we have to add the NFI, that is 20,000 crore. Minus 20 plus 20 cancels out. Correct answer comes out to be 9 lakh crore. B is the right answer. Right? B is correct. Okay. Fine. Now let's just move towards our next discussion, next module questions, which are uh, so module A and B. Now we can say for sure that we have revised. Apart from that, this PDF will be attached in the virtual library. You can directly download it from there also and see for yourself that if you have to revise something or not. This we have done. MEGA, GNP, GDP. That's also done. Now let's talk about this question. Find bond valuation theorem. Bond valuation theorem. Module D. Everyone, just read the question first and try to answer. Fine. I'm not saying that you won't be doing it. We'll do it. But just imagine that this question appears in the tomorrow's exam. What will be your answer? Even if you know, do not know, try to answer this question. Let's just have that mindset. Let's just start to think in that direction. Bond valuation theorem. I'll be explaining each and everything, but first try to answer. Okay, so I can see that students are already answering B. Okay, okay. What about others? Everyone. I can see Sangeeta, Sishu, Simran, Kiran, they are with B. What about others? See, let's read the question first. Fine. Investor is comparing two bonds, bond A and bond B, during a period where the market interest rates are expected to fluctuate. Fine. Market interest rates are expected to fluctuate. Fluctuation is there. 10-year maturity and 3% coupon rate is for bond A. Fine. Bond A is having this much maturity and the coupon rate. Bond B, on the other hand, has 5-year maturity and 5% coupon rate. So whenever there is a difference between the coupon rate or for that matter maturity time period, you must have some important points in your mind. That according to which theorem the particular yield or for that matter market fluctuation will impact the maturity, fine, or will be impacted by the maturity or coupon rate. So we have seen the lower coupon rate, the more chances are there for the impact, fine. So more impact will be there. Higher the tenure, fine, higher the maturity, you will have more impact, fine. These are the two things. And when we talk about higher the tenure, higher the maturity, who is having more maturity here? 10-year or 5-year? 10-year. So bond A is with the higher maturity. So more, you can say, sensitivity to market will be there out of these two at least. And then lower coupon rate. Lower is what? Again, bond A, 3%. So more sensitivity to the market will be there for bond A. And these theorems, when we talk about these theorems, what theorems are these? These are your theorem 3 and 4. Fine. 3 and 4. Okay. So according to this particular case, now we understood that what will be happening. And once you understood that this phenomena will occur, then you read the statements, it will make much more sense. Based on the theorems provided, which of the following statements is correct regarding the price sensitivity, the volatility of these bonds? We are talking about the volatility. So if the interest rate increase by 1%, bond B will experience a large percentage increase, large percentage decrease in the price than the bond A because it has higher coupon. So higher coupon means more sensitivity or lower coupon means more sensitivity. Lower the coupon, higher is the sensitivity, higher is the volatility. So this is a wrong statement. Bond A will be more sensitive to the interest rate changes than the bond B. Bond A, definitely it is more sensitive. Just now we have concluded because it has both longer maturity and the lower coupon rate. That is absolutely correct. B is the right answer, right? B is the right answer. For this particular case, B will be the correct answer. Yes, yes, option B. What if bond A had both higher? If bond A had both higher, means maturity is also higher and coupon rate is also high. So if we compare that scenario when the higher maturity is there and coupon rate is also high, let's suppose 6% is there. That's what Prashant, you are telling us. So in this particular scenario, what will happen? Higher the maturity, your sensitivity will be higher. And when we talk about the 6% coupon rate, it won't be applicable in this particular case. You won't be able to compare these two in this particular parameter. So we will be comparing bond A and B only on the basis of maturity then. Right? Then only we will be saying that yes, bond A will be having, it might have, fine, it will be having, that's not a certainty, it might have more sensitivity as compared to the bond B in a specific scenario. On the other hand, there will be some scenarios where since now the bond B is having the higher, no, lower, yes, now it has the lower coupon rate, then chances are there that more sensitivity in some scenarios will be for bond B. So like that we have to analyze. Okay, tenure and interest both are high. Right? So in some scenarios you might find that A will be receiving or having more sensitivity. In another scenarios, another market conditions, you will find that bond B will be having more sensitivity. Accordingly, the option statements will change. Okay, fine. So for this question, the right answer is option B. For that though, I think statement will change only. Fine. We won't have the same statements then because when we talk about such situation where one particular bond is having higher rate of interest as well as higher tenure, and the another one is not having any kind of changes, then what will happen? In some scenarios, bond A will find that yes, sensitivity is high. In some scenarios, as we move towards the rate of interest, the coupon rate, we will find that bond B will be having the higher sensitivity. Then the options will change, right? Okay. So when we talk about the bond valuation theorems, what we have to remember? You need not to remember anything but only one particular small revision line. This line I want everyone to remember. Only this line. So theorem 1 talks about inverse relationship. What is inverse relationship? The price of the bond is inversely related to the changes in your interest, right? Whenever you are holding a bond which is having 10% as the coupon rate, and in the market the rate just now has increased to 12%, so your bond will look like what? That it is not paying well, 2% less it is paying to you. So ultimately the price of your overall bond will fall, it will become cheaper as compared to the market. So price is inversely proportional to the change in interest rate. Whenever the interest rate is increased, your price of the bond will decrease, right? And whenever the interest, supposedly now you are holding 10% and the current market rate, coupon rate is 8%. So now your bond will look like a more lucrative one. So whenever the interest rate is lower in the market as compared to your coupon, you will find that the price of your bond will rise because it is now a very lucrative investment for other investors, right? So yes, first theorem is price is inversely proportional to your interest rate. Then comes gain is greater than loss. So how to explain this? Whenever we have this price fluctuations, you will have sometimes loss, sometimes gain. So when the price decreases, you will have what? You will receive some loss. And whenever price increases, you will receive some profit, or for that matter, you can gain. Right? So theorem 2 states that this profit which you have gained, the cumulative profit, final profit, it will always be greater than the loss, always. And how we are saying this? Because the theorem 2 has undergone is the outcome of various mathematical expressions. The economists have finalized this theorem based on the experiments which they have done in the financial market. So the final outcome will be gain is always greater than loss. Then comes lower the maturity, more sensitivity. That is your theorem 3, right? Longer the maturity. So when you talk about greater maturity, you will find greater sensitivity, right? Greater maturity and your greater sensitivity will be there, which we have seen in this particular question also. Then lower the coupon, you will have more sensitivity, right? So these four you should remember. Only these 4 points you must remember, and you will be good to go. Rather than going through the statements, big statements, learning like this, that what is happening in 1, 2, 3, 4 directly, just have these 4 pointers in your mind and you will be able to solve the questions. Okay, till here it is fine. Now let's talk about call and put option. Which of the following statement is incorrect regarding the call and put option? Call option is right to buy an underlying asset at a fixed price at a future date. Put option is the right to sell an underlying asset at fixed price at a future date. Call option is the obligation of the option writer to sell an underlying asset at a fixed price and a future date. Or put option is the obligation of the option buyer to buy an underlying asset at the fixed price at a future date. What will be the right answer? Call option, put option. Simple definition based question. See, such one liner questions you have to solve within 10 seconds. Right? That should be your mindset. Yes, correct answer is option D. Fine. Incorrect they have asked. Fine. A put option is the obligation of the option buyer to buy an underlying asset at a fixed price at a future date. Fine. That is not correct. The put option is not an obligation of the buyer to buy the underlying asset at a fixed price, that too at a future date. No. Let's see one by one what we are talking about. Option buyer or the option holder, in this scenario when you are the buyer or the holder, for the call option you will be buying the right to buy the underlying asset. Fine. So derivatives market we are talking about, and in the derivatives you have the underlying assets like your debt or equity instruments are there, and based on the debt or equity instruments prices only your derivatives price will go up or down. And if you want to buy these derivatives or the equity instruments, then which option you must exercise as the option buyer? You must exercise the call option, right? The right to buy the underlying asset at specified price. Put option, simply you are buying the right to sell the underlying asset at a specified price, right? So you are holding an option, right? You are the option holder. Okay. So you are holding the option only. You have the right, not an obligation that somebody will come and say that yes, you have to give it to me, you have to sell it to me, or for that matter, you have to purchase from me. No. It is just the right which you hold. Then comes your obligation. Fine, obligation part. It comes when you are the option seller or for that matter option writer. So you have the obligation to sell. You have you are the seller now, so you have to sell the underlying asset. You have the obligation now. Okay, to sell to the option holder at the specified price. So option holder is who? The option buyer. They will ask for it. You will have to deliver. You have the obligation to deliver. Put option has the obligation to buy the underlying asset. Fine. You have the obligation to buy also the underlying asset at a specified price. So in the put option, you will be obligated to buy the underlying asset at a specified price when you are the option seller. In case of option buyer, you are having the right to sell the underlying asset at a specific price, right? So always remember obligation to buy occurs in case of put option when you are the seller, right? And in case of put option only for the option buyer, you have the right to sell. Here right to buy you have in case of the buyer for the call option. In the option seller part you will be having obligation to sell, so it is inverse. Yes. Okay. No, not the owner, you are just holding it. Fine. You don't own it. Fine. You will own once you buy it. You are holding it for the trade. Okay. Fine. Now let's talk about the options contract in the derivatives market. Select the correct statements from the following. Option writer is the one who buys an option which can be a call or put option. It can be call or put option. Option holder enjoys the right to buy or sell the underlying asset at a specified price on or before the specified time. So option writer is the one who buys the option. The writer, we have just now seen option writer, right? It is the one who buys the option, which can be call or put option. So you are doing what? You are having the obligation to sell, obligation to buy, right? Which can be call or put option. Option holder is who? We have seen in the option buyer. So buyer or holder. They enjoy the right to buy or sell the underlying asset at specified price on or before the specified time. American option is the one which can be exercised by the buyer on the expiration day only. No, that is European option. Fine. European option. European option is the one which can be exercised by the buyer on or before the expiration date. So no, that is the American option. So what is the right answer here? Anybody? Okay, so I can see that B is the right answer. Some Prashant is with B. Girish, Simran. What about others? See, everybody should try to answer this question because this is not a tricky one, just based on the definition. This will tell us that whether we are on track or not. Okay, okay. B is the right answer. Yes, option holder enjoys the right to buy or sell the underlying asset at a specified price on on or before the specified time. Okay, B is correct here. Fine. So when we talk about your option holder, what is happening there? The one who buys the option, fine, that is your option holder, right? And who is the option holder? The buyer, right? So option buyer, or for that matter option holder, how you should remember, let's just break it down so that the confusion is not there. Option buyer, or for that matter we are talking about the holder, buyer or the holder, one at the same thing. So buyer has a right. Always remember, the buyer will be having a right. No choice is there. Fine. The particular choice is there. No obligation is there. Fine. So you have the choice. It depends upon you whenever you are the option buyer. So you will be doing what? You pay a premium for this right. To obtain this right, you have to pay, right? So premium will be paid by you, and ultimately you will enjoy this right. You will be the option buyer or option holder. Okay. So this is the basic agenda. Now comes the call and put option buyer. Fine. So option buyer, everybody understood. Now we have call and your put options. Fine. Call and put. Call and put. So in case of call option, what will happen? Simply, you will be having the right to buy. Call means call and buy the asset at a fixed price. Fine. You want to buy it. So you will be doing what? Calling to buy. Right? The right to buy the asset at fixed price. In case of your put option, what will happen? You will be having the right to sell. You have the right to sell the asset at a fixed price. Fine. So put means selling, and ultimately when we talk about call, it will mean that you want to buy at a fixed price. That is your right. Fine. You can or you may not. You may or may not. So why you will be using this buy option? Call option is buy option, na? So you will using it whenever the price is expected to go up. Right now, I know that after 2 days, the prices will go up for this XYZ financial instrument. So I'll be buying it right now, buy at cheaper rate and sell it at a higher rate. So I will buy it. Okay. That is the advantage of having the option buyer, right? Of being a option buyer, of being the option holder, and having the call option with you, fine? Call option buyer. So whenever the market is expected to grow, fine, expected to go up, then you will be doing what? Going with the call. But when we talk about the put option, what will happen then? Simply whenever the market is expected to go down, that yes, after 10 days my investment will mean nothing, so what I should do? I should sell it away. Now the prices are better. Supposingly today somebody is giving me 10 rupees for this investment, after 10 days it will be only 2 rupees. So better that I should sell it now, so that I won't receive the loss of 8 rupees, right? Okay, so this is how you define the option buyer or the option holder. Then that is correct, everybody. Till now everything is fine. Holder will not sell as such. मतलब सिर्फ only sell is not there. They can buy also. Fine, buy and sell both. Fine. Holder means what? You have the right. You are holding the right. You can understand like that. Fine. So option holder, who is also known as option buyer, you buy a right. Fine. You buy this right. You hold this right. And how you buy this right? By paying a premium. Fine. Okay. Then comes your option seller. Who is this option seller now? See, when you talk about option seller, here also, so that you understand in a much better manner. So option seller is the option writer. Fine, option seller or writer we are talking about. So who is this writer? Simply who has the obligation. Fine, the seller has the obligation. Always remember, seller has to sell. Fine. And why has to sell? Because the seller is the one who has received the premium from the buyer. Fine, buyer pays a premium to whom? To the seller only. Okay, so they have, the seller have the obligation. Fine. So option seller or the writer, they will be receiving the premium from the buyer. And that is the reason why obligation is there on the seller. So when we talk about the call option, in the call option seller, what will happen? They must sell. They must sell the asset if the buyer wants. If buyer thinks that ultimately this asset will be priced higher after 10 days, let me buy it. So who will sell? Option seller will sell. Fine. So you must have this particular case in your mind, that whenever the buyer wants, your seller will sell. They must sell. This is what the call option. So call option for the buyer was what? Call option for the buyer was that they want to buy. They want to buy. So the party which is selling, for that also it will be the call option. Fine. They are selling in that call option, right? Okay. So remember like this, call for the buyer means buying. Call for the seller means that you have to sell. Fine. What is the internal call of the buyer? To buy. What is the internal call of the seller? To sell. Like that. Fine. Then we have the put option. Fine. Put option seller. Again, whenever the buyer, the option buyer wants to sell something, you have to buy. You have the obligation because he has, or he or she has paid you the particular premium. Fine. So put option, what will happen in the case of seller? We are talking about the writer or the seller. Simply, you will be have to buy. You must buy from the buyer or the holder. Exactly opposite of what the option buyer or the holder is doing, because one party will buy, one will sell. Another party, in the second scenario, what will happen? One party will be selling, another will be buying. Okay, right? So buyer means what? They are having a right. These buyers are having the right, and for this right only they are paying a premium. Paying a premium to whom? To the seller. So now the seller is obliged, is obligated to sell or buy whenever the buyer wants. Okay. Now I hope that it makes sense. Everybody, now it makes sense or not? Right. So now let's move ahead. Try to solve some more questions then. Fine. Okay. Okay. Uh, Thank you, Divya. With reference to the RBI guidelines on CDS, credit default swap CDS, in the derivatives market, select the correct statements from the following. RBI issued draft guidelines for CDS in February 2016. No, the draft was what? Draft was in 2021. So this is a wrong statement. RBI proposed to allow retail users undertake transactions in permitted credit derivatives for hedging their underlying credit risks. Fine. So proposal was there, fine, in the CDS derivatives guidelines. So these are what? These are the exact things which were written in the draft guidelines. Non-retail users should be allowed, they shall be allowed to undertake transactions, right, in the credit derivatives for the both hedging as well as other purposes. What will be the right answer? So non-retail users must also be there, and your RBI also proposed to allow the retail users. Yes, the right answer is option B, 2 and 3. So 2021 was the ultimate year when the RBI issued these guidelines. And under the said guidelines, RBI proposed to allow the retail users undertake the transactions. What are these credit default swaps? We'll be doing one question for that also. But right now, just imagine that these are some type of financial mechanism ongoing in the financial market. Fine. Transactions in the permitted credit derivatives for hedging their underlying credit risk. Non-retail users shall be allowed to undertake transactions in the credit derivatives for both hedging as well as other purposes. Fine. So both retail as well as non-retail. Fine. Now let's talk about the CDS. With reference to the credit default swap in derivatives market, select the correct statement from the following. CDS is a financial derivative or contract that allows an investor to swap or offset his or her credit risk with that of another investor. So, when we talk about CDS, one will be the borrower, one will be the ultimate lender, and one will be the CDS seller. So lender will lend money to the borrower, but since the borrower is not paying back, or for that matter, at least lender thinks that the borrower is not having the capacity now to pay back, now the lender will go to the CDS seller, fine, trying to swap the credit default, which might be there from the borrower's end. Right now, we don't know exactly, but it might occur from the borrower's end. So, in order to safeguard itself, the lender wants to safeguard itself from any credit default, they move towards the CDS mechanism. And to the CDS seller, the particular lender will keep on giving the premium amount on regular basis. So if the borrower actually defaults, then the lender is saved from any credit default. The risk will be borne by this CDS seller. But if there is no default as such, so the particular lender will lose the premium amount. Okay, what is the right answer here? If the lender is worried that the borrower is going to default on the loan, the lender could use a CDS to offset or swap that particular risk. Fine, offset or swap you can do. To swap the risk of default, the investor or the lender buys a CDS from the CDS seller who agrees to reimburse the investor in the case of borrower's default. Yes, that is what we were talking about, CDS seller. Correct answer is option D. All are correct. Fine. So what is this CDS? I hope that you understood that what we are talking about. Simply, credit default swap is like an insurance on loan or bond, right? Just like an insurance only. You are providing it to some lender. If you lend money or buy bonds and fear that money may not be repaid, now you can buy a CDS to protect yourself. Fine. How it works? Simply, the lender will has lended supposedly 10 lakh to a company, but now you worry that this money won't come back. So you buy a CDS from another party. You pay a regular premium, the fee, right? And in return, if the company defaults, the CDS seller pays you the particular loss, whatever loss you have. If no default happens, you will lose only the premium. If default happens, you get the compensation. Fine. So premium will be lost. Yes, that is the ultimate risk. Fine. That is also one of the risk, but a smaller risk. But default happens, that is a very big risk, and you will get compensated. That is a relief thanks to CDS. But risk still exists because CDS seller also fails. If the CDS seller fails, then what? The risk will be there in the market. It will be absorbed by various market players. So risk still is there. In India, CDS market is regulated by RBI, and only you will find eligible entities, mainly banks, financial institutions. They act as the CDS seller. Minimum three parties are involved here. One is borrower, another is the lender who gave the money, and the CDS seller who will give the protection. Fine. This is the same question which we have done. Now let's talk about one question. This we have done. Right. Okay. Now let's move on to the fundamental principles governing the insurance products. Okay. Why CDS will be because that's their own vertical. Fine. We will find that many risk absorption mechanism are there in the market. Right. Okay. So via the risk absorption mechanism, they will be ultimately absorbing the risk. Fine. Okay. So banks, financial institutions, all these, they will be bearing the risk. Just like the guarantee, I think in the last class, in the bilingual medium, we were discussing this point only, that just like your CGFMU, like your CGTMSC. Okay. Right. Even if when you talk about the normal phenomena, like in insurance products, we are learning the insurance products also. So there also the company only receives the premium, still they are paying you the money, right? So there are various financial market absorption, risk absorption mechanisms via which they will be recovering the money. Okay. Like in this particular scenario only, we will be learning about the principle of subrogation. Here the insurance company will be taking the risk from the ultimate party to which they have provided the insurance and suing the third party. Right? So we'll be learning that. Okay. Fine, fine. So now let's start our discussion around the principles of insurance products. Very, very important. These insurance products, they can ask you directly in the examination. The most important being your principle of indemnity. So first one is principle of utmost good faith. Here, what you have to remember, that both the insurance company as well as the insurer, both as well as the policy holder, both must be very much clear in their mind that you have to be 100% honest. Right? So insurance company, how the insurance company should be honest, they should tell transparently whatever the terms and conditions are for the insurance claim in future, and the insured person, they must be very much clear that yes, these are the points via which I should write these are the points which I should tell the insurance company, otherwise in future my claim will be rejected. So whatever the facts you have, you must tell your insurance company. That is the utmost good faith. Be 100% honest. That's the keyword you should remember. Then comes principle of insurable interest. Insurable interest means if the particular event has provided a financial hit directly to you, then only you can claim the insurance, otherwise not. Fine, directly to the policy holder. Principle of indemnity. Indemnity means what? That only we will be covering the damage. Whatever the damage is made, we will protect that. And who will say this? The insurance company to the insurance policy holder. Principle of subrogation. It is simply a legal right of your insurance company to step into the shoes after paying your claim. This is what we were talking about. Just like you can say CDS also. Fine, they are doing this already. So what is happening here? Your company, the insurance company will pay you money. Supposingly there is an accident and the damage is done to your car and the damage was done by a truck. Right? So you will approach your insurance company. They will make good of the damage. They will give you the damaged goods amount and ultimately your car is repaired. You are happy. You move out of this particular scenario. But this truck which has the direct collision with your car, had the direct collision with your car, this truck will be you can say truck driver or the agency will be sued by the insurance company, and from these particular uh, proceedings, court proceedings, insurance company will recover the amount. Fine. So you have done what? You have transferred your right to your insurance company in order to recover the money from the third party. Fine. It is a legal right of your insurance company. So step into your shoes. Once the insurance company has paid your claim, your car is as new now. They take over your right to sue the person who caused the damage. That is your principle of subrogation. Then comes principle of contribution from various companies. If you have the insurance, let's suppose for shop, you have 10 lakh insurance with the LIC, another 10 lakh with the HDFC, and damage you have suffered of 5 lakh. So you will find that this 5 lakh will be equally contributed by these two insurance companies if it is written in the clause. If not, then whatever is written that will be paid, but ultimately you will be paid for the amount which is equal to your loss, right? Loss only. It's not that you have two insurers, so you will say that yes, each should give me 5 lakh. No, the loss will be there. Whatever the loss amount is there, we will be paying that. Again, principle of contribution is in light with the principle of indemnity. Whatever the loss is there, we'll be paying it to you, not to make a profit. Then principle of proximate cost was, what is the exact reason? Fine, that you have to tell the insurance company if you want to claim a particular insurance. So if a loss is caused by a series of events, the nearest one will be decided that how ultimately this particular event has occurred and whether you will be able to receive the insurance amount or not. The nearest one, fine. Average claim, average claim where? This average claim. The principle of contribution. Can you just type the principle, which principle you are talking about? So in the meantime, let's just try to have one question from the principle of indemnity. The numerical question, the formula based questions, which we have been doing regarding the sum insured, value of insured asset, actual loss. That's what is your principle of indemnity. So the question will be like this only. You will be given the sum insured, you will be given the value of insured asset and the actual loss. So 8 lakh divided by 10 lakh multiplied by 6 lakh will give you the right answer. And this will be what? The compensation amount. Fine. So the formula you should remember the theoretical part also of the principle of indemnity in case of your insurance chapter. Fine. Theoretical part at least. That's what you should remember, right? Average claim, Prashant, can you tell me which average claim you are talking about? Else we will move forward. Are you talking about the total loss and the average claim? As per the indemnity, it should be six. No, no, no. It will be calculated, na? The amount of compensation will be calculated based on the amount of the insurance which you have bought, right? The sum insured. If for your 10 lakh asset you have the sum insured 10 lakh only, then the total loss will be compensated. But here the claim will be directly linked to the actual loss, fine. So there is a difference between your actual loss and your total loss. Total loss will be given to you when the sum insured is directly proportional to the assets value, the entire amount. So 10 lakh was the asset value. If the sum insured was also 10 lakh, then you will be able to receive the 6 lakh. But what happens normally in the actual loss, or for that matter actually what happens in the insurance market, we will be receiving some amount less as compared to the actual compensation which we desire. Why? Because of the insurance sum insured value, right? So it depends upon the sum insured that what will be the insurance compensation you will receive. So first is sum insured, and then based on the sum insured, whatever the amount is which is pertaining to only the damages, we will be giving that to you under the principle of indemnity. Okay, fine. So now let's move on ahead and try to remember the other important schemes. Atal Pension Yojana APY objective is simple, that in order to provide steady pension for the citizens of your unorganized sector, in the unorganized sector, pension amount, monthly pension ranging from 1000 to 5000 upon reaching 60 years of age. Fine, age is 60 years. Primary KYC requirement, Aadhaar card is mandatory for the registration, very important. And when we talk about the minimum amount that can be contributed is based on your age at the time of the registration. So this you have to remember that it depends upon which parameter they can ask. So age is the parameter. Pension amount you are subscribing to, it can be ultimately the amount which you will be receiving. It will be ultimately 1000, 2000, 3000, 4000, or 5000, between 1 and 5000. You can contribute to the pension scheme on monthly, quarterly, or half yearly basis as well. Then comes eligibility criteria. So any Indian citizen, they are eligible, must be between 18 to 40 years old. Banking, when you talk about the number of bank accounts you will have, so must hold at least the saving bank account, only then the APY scheme you are eligible in. Some conditions are there. Government employees are eligible to join, but when you talk about the taxpayers, they are not eligible. Account limit, one APY account only per person. Contribution and tax benefits. So the government co-contributes 50% of the corpus, whatever the subscriber contribution is there. 50% of that will be contributed by the government also. So subscriber, let's suppose, has 50,000. So we will be adding 50% of 50,000, that is 25% to the corpus. So this is the amount which should have been added. But ultimately, most of the cases we find that this amount is there as the government's contribution, that is 1000 per year. Okay, whichever is lower, right? So 25,000 and 1000, which is lower? 1000. Then tax incentives, section 80 ccd1, deductions available up to 1.5 lakh. 80 ccd 1b 50,000. Voluntary exit is permitted, yes, before the age of 60 under specific conditions. Specific conditions are there, you can also exit then, like you need the funds, you do not have the capacity to pay, etc. Provisions in case of death before 60 years of age, if the subscriber passes away before the reaching of your 60 years of age, the spouse will be having the ultimate decision to make. What are the choices before the spouse? Continue the scheme, you can continue also, and you can immediate settle also the funds. If you continue, then contributing to the account in the own name for the remaining time period. Fine. So supposingly the particular individual dies at the age of 55. So from 55 till the age of 60, you the remaining 5 years basically you will be contributing to the fund. Fine, in your own name. The spouse will be doing that. This is allowed even if the spouse has a separate APY account. And why we are mentioning this? Because we have seen that one individual equals to one APY account. But here you are already having APY account, still you are contributing in another account. Yes, because that person is the deceased spouse. The spouse receives full pension amount until their own death. Fine. So pension amount will be received by the spouse only. Immediate settlement, the entire accumulated pension corpus is paid out lump sum to the spouse or the nominee. After that, we have Pradhan Mantri Jeevan Jyoti Bima Yojana and Pradhan Mantri Suraksha Bima Yojana, PM JJBY and PM SBY. So PM JJBY, we have the purpose simple, offers the life insurance coverage to individuals and the families. For your PM SBY, provides the financial coverage for your accidental death or disability. The scheme provides life insurance in case of JJBY. SBY, it provides accidental insurance. Age eligibility, the age ranges from 15 years to 50 years in case of JJBY. SBY, the age ranges from 18 years to 70 years. When we talk about JJBY, the premium amount is 436 a particular year, yearly plan is there, and annual premium in case of PM SBY will be rupees 20. Insurance coverage, lump sum 2 lakh to the nominee in case of death. SBY, you have 2 lakh in case of death or total disability and 1 lakh for the partial disability. Then we have tax benefit also 80C and section 1010D. You are eligible for the tax deduction. PM SBY again 80C and 1010D. Claims up to 1 lakh are tax free under your 1010D. Then we have renewal period. So 1 year life insurance is there, renewable every year, your Jeevan Jyoti Bima. And Suraksha Bima Yojana, 1 year coverage, renewable every year. For your enrollment period, the coverage period runs from 1st June to 31st May, and your SBY 1st June to 31st May. So this coverage period is very, very important, 1 June to 31 May. Apart from that, we have to remember the premium amount and the age limit along with the insurance coverage. So age limit, premium amount, insurance coverage, and your enrollment period. These four things you must remember. Okay, very important. Fine. So yes, I think that we have completed all the pointers here or not. EIA account we have done. Yes, this we have not done. Okay, this is the portion which we are left with. Fine. According to the prudential limits for the borrowing, what is the maximum amount a scheduled commercial bank is permitted to borrow in the call and notice money market on a single day? Fine, we are talking about the single day. Average 100% of the capital funds per fortnight. Internal board approved limits. Maximum 125% of the capital funds. 2% of the aggregate deposits as of the end of previous financial year. What will be the right answer? See, the table is very important. Prudential limits table. All the financial institutions you must remember. Okay, REIT invites. We will see that. Don't worry. We'll see REIT and invite. So correct answer is option C, maximum 125% of the capital fund. Scheduled commercial banks. Scheduled commercial banks, including the small finance banks, we have what? In the call and notice money, average of 100% of the capital funds per fortnight, maximum 125% on any single day. Then term money, internal board approved limits are there. Accordingly, you will be having the term money potential limits. For the payment banks and the RRBs, call notice and term money average of 100% for the capital fund per fortnight, the average which we talk about, maximum 125% on any single day. Cooperative banks, simply for the call notice and term money, since the cooperative banks lack funds, so their benchmark will be your aggregate deposits, not the capital and all. So 2% of the aggregate deposits will be there as the end of previous financial year. For primary dealers, the call notice and term money limitations, or for that matter, prudential limit, it stands at what? It stands simply at average of 225% of the net owned fund. Fine. This table is highly important. If any one of you is not aware of this table, I would highly recommend that go through it once. Fine. From here, you can expect a direct question. Then, which of the following statements is true regarding the NDS-OM, NDS order matching system? So it was introduced in 2002 to replace the electronic trading with the telephone based methods, or it serves as primary market module exclusively for reporting over the counter trades, only for OTC. No, it is, but not only. Anonymous order driven trading system for the government securities, primarily government securities, launched in 2005. It is a manual system where all the members have identical access to settlement features. What is the right answer then? Yes, the correct answer is option C. Anonymous order driven trading system. Fine, you will give the order and ultimately the trade happens on this particular NDS OM. So this is how it looks like. Email ID, mobile number, or for that matter, username if you have, you can fill that, and then the password you will log in into the RBI NDS OM. What is your NDS OM? Negotiated Dealing System Order Matching Platform. It is an electronic platform by the RBI for trading government securities and money market instruments. Fine. So there will be the display in the front page itself, the front, you can say, uh, face of your website only. Here you can see the government securities listed. There is again government security. Fine. So introduced in 2002, it aims to enhance transparency and efficiency, moving away from telephone based trading methods. NDS-OM launched in 2005. Fine. So NDS was launched in 2002. NDS-OM launched in 2005. And it enables anonymous order-driven trading in government securities, specifically government securities. It has direct, indirect members, different access levels to trading and settlement features. NDS includes primary as well as secondary market module. Primary module, auction for the government security. Secondary module, over the counter trades. Fine. So both the things you should remember. Fine. Now, which of the following best describes the ultimate goal of the price discovery process? Price discovery. Try to answer. So to ensure that sellers always receive the highest possible price regardless of market demand. Regardless of market demand, we are having the highest possible price. Whether this is possible, right? Sellers always receive the highest possible price regardless of the market demand. Fine. Market demand will govern the private your price discovery process also. Fine. Always you cannot just oversee the functions and say that yes, I have a mechanism via which I will give you such kind of scheme. Right. To find the equilibrium price that facilitates the greater liquidity for a specific asset. For a specific asset, to limit the amount of available information to keep market volatility low or high, or for that matter, stable. To allow the market mechanisms to set the prices independently of buyer and seller interactions. No, buyer and seller interactions, if they will be if they are interacting, then only that demand and supply will go. And price discovery is based on what? The demand and supply mechanisms. Bank question. Which bank question? So what is the right answer? Price discovery, to find the equilibrium price that facilitates the greatest liquidity for a specific asset. Fine, liquidity must be ensured. We are trying to find the equilibrium price, and this price discovery process is there for the shares also, right? Whenever the IPO comes, we say na that price discovery process is done or not. Have you monitored the market or not, right? And monitored the market how? Via going through various factors: supply and demand, attitude towards risk, volatility, what is the available information of the peers, and your market mechanisms. Fine. All these clubbed together will determine the level of your price discovery. Price discovery, of also referred to as price discovery mechanism, price discovery process. It is a method for determining the price of an asset. Fine. You are trying to determine the price of the asset through interaction between buyer and seller. So always remember, buyer and sellers, they are doing what? They are interacting, and based on that, you are determining the price of the asset. So this statement which says that independently of buyer and seller, this is absolutely wrong. Fine. Price discovery enables buyers and sellers to set the market prices of tradable assets. Fine. Shares also, as I was telling you for the IPO. This is because mechanism of the price discovery set out what the sellers are willing to accept and buyers are willing to pay, the equilibrium, as we have seen in your supply and demand also. Fine, equilibrium will be achieved. As a result, price discovery is considered with finding the equilibrium price that facilitates the greatest liquidity for that asset. Incoming, outgoing price. Fine. Incoming means the price at which it has been sold, or for that matter, outgoing, at which it will be bought. Okay, Bank Quest. Bank Quest, I think PPB. In PPB, there will be some areas where they can ask you from the latest updates till December 2025, December 2025. Fine. What about DUPN then? In the context of Indian banking and bill rediscounting, what is the primary purpose of derivative use once promissory note, DUPN? To replace a physical vault with a digital storage system for paper bills, to act as a single legal instrument that represents a collection of multiple small underlying bills, to allow banks to issue new loans without any physical collateral paper or physical collateral or paperwork, or to cancel the debt of small businesses by converting their bills into bank note. What will be the right answer here? We are talking about a single legal document, and all those small multiple bills will be attached, right? Collected and attached. DUPN, correct answer is option B. Yes. To act as the single legal entity that represents collection of multiple small underlying bills. Good. B is the right answer. In India, instead of physically handing over thousands of small bills to HDFC, Bank of Baroda will be issuing DUPN. This is just the part of the example. In our class, we have seen that there is an example wherein HDFC will be having tie-up with the Bank of Baroda, and they will be having the ultimate transaction based on various bills. Right? So instead of handing different bills, 1 2 3 bill 1 2 3 4 to HDFC, Bank of Baroda will do what? They will issue one DUPN, and the DUPN will be issued via a single legal note, and it will state that this note represents bunch of genuine bills we have in our vault. Fine, all these bills are present in our vault. It makes the transaction much faster and easier to track. So they will club together the small bills and ultimately provide it to the other party. Fine. Which of the following statements best describes the primary characteristic of cumulative preference shares? Fine, CPS we are talking about. Dividends are paid only when the company makes a profit and do not carry forward if skipped. So company is not making profit. So what we will do? You should cumulate, fine, all those previous you can say profits cumulatively will be given to the preference shareholders prior to the equity shareholders. Unpaid dividends accumulate and must be paid in full to these shareholders before any dividends are paid to equity shareholders. Fine. Shareholders have right to vote on all the company matters, regardless of whether dividends are paid? Yes or no? Dividends are paid to equity shareholder first, followed by preference shareholder. No, always remember, preference shareholders will get preference over the equity shareholders. After the promoters, after the owners, you will get the cumulative. You will get the preference over the equity shareholders. So correct answer is option B. Unpaid dividends accumulate and must be paid in full to these shareholders before any dividends are paid to the equity shareholders. Fine. So cumulative preference shares, this is a type of preference share only on which dividend accumulates. Fine. That is why the term cumulative, if it remains unpaid. All the arrears of preference dividend have to be paid out. Fine. The arrears will be paid out before paying dividend on equity shares. Fine. So whenever the loss is there in a company and next year they have the profit, so the equivalent of the previous year should be paid this year also along with the profit. So if the company skips a dividend 1 year due to the losses, the amount accumulates and must be paid in full later before any equity shareholder gets a single rupee. That is the benefit of holding the preference share, and it comes with a cost also. They will be expensive as compared to the normal shares. Many Tata Motors preference shares are structured this way to ensure investors eventually get their promised returns, even if automotive cycle hits a rough patch. Even if for 6 months, 10 months, the cycle is not good, they're not receiving any profit. But thanks to this cumulative preference share, they will receive the payouts once the profitability kicks in. Fine. Next, we have under the RBI Retail Direct Scheme, RBI Retail Direct Scheme. What is the specific name of the account that individual investors are required to open and maintain the RBI with the RBI to invest in government securities? Yes, yes. The entire document, a separate document will be made for the preference shareholders. Okay. So whenever we have a offer document of for a particular share, they will be having a separate mention. So retail direct scheme, we are talking about which of the following: invest in government securities, reserve bank savings account, retail direct gilt account, negotiated dealing system account, or sovereign gold bond digital account. What is the correct answer? Yes, the right answer is RDG, retail direct gilt account. So retail direct scheme, RBI's retail direct scheme is a one-stop solution to facilitate investment in government securities by individual investors has been issued. Right? The highlights of the RBI retail direct scheme, they are what? Retail investors, the individuals will have the facility to open singly or jointly and maintain the retail direct gilt account, RDG account with RBI. RDG account can be opened through online portal provided for purpose of the scheme. Open portal for the online portal for the purpose, exact purpose of the scheme. And what is the purpose? The purpose is very simple: investment in government securities. The online portal will also give registered users some additional facilities like access to the primary issuance of government securities and your NDS, NDS OM, negotiated dealing system, order matching system. That is your NDS OM. So here you can see this is the retail direct schemes website. Find this website under the RBI retail direct scheme. So you can open the RBI retail direct account or redirect yourself to the NDS OM secondary market. Right? So it is available over the website also. Now, which of the following best describes the primary status and membership of FIMDA? Status and membership of FIMDA. Government run regulatory body consisting only of international investment firms, a voluntary self-regulatory organization SRO representing commercial banks, financial institutions and primary dealers, a mandatory trade union for individual bank employees working in derivative sector, or for that matter a branch of the Reserve Bank of India specifically designed to sell the new bond instruments to the public. So FIMDA is simply one SRO and it represents the association of what? commercial banks, financial institutions, and primary dealers. B is the right answer. So FIMDA, Fixed Income Money Market and Derivatives Association of India. It is a self-regulatory organization, SRO, and the association is what? Association of Commercial Banks, Financial Institutions, Primary Dealers, and is a voluntary self-regulating institution for the bond, money, and derivative markets. What is the role of FIMDA then? It functions as a principal interface with the regulators. Then also it undertakes developmental activities like introduction of benchmark rates, new derivative instruments, etc. And also to provide training and development support to the dealers, support the personnel at the member institutions also. Also to have the devise the standardized best market practices and implement them and try to implement them via the market regulator. And who is the market regulator of fixed income money market? Anybody? Everybody in fact should tell. Also to adopt and develop the international standard practices and code of conduct uh, in the above field of activity. Fine. So have the standards set according to the international standards. Nurturing markets, widening horizons. That's the tagline of IMDA. Fine. How many currencies were was the London Interbank offer the rate issued? Right? How many currencies? For how many currencies? Okay. For how many currencies was Libor issued? Libor used to be issued for 4, 5, 6, or 7. How many currencies? What is the right answer? And derivatives, yes, derivatives SEBI. What about the fixed income money market? Sir, hmm? PIMDA, we were talking about. It has fixed income money market and the derivatives also. Derivatives to SEBI, FIMDA, your fixed income, it is your RBI, right? RBI. PDF you will get from the virtual library. The link is pinned here in the description box. And if you are a paid subscriber of our courses, then the WhatsApp group which we have, I'll be posting there once the session is over. Fine. So how many currencies they were having? Only five. So yes, we were having six currencies, na? Not five. C is the right answer. Here you will have C as the right answer. So US dollar, British pound, euro, Swiss franc, Canadian dollar, and Japanese yen. Libor was very popular benchmark and was issued for six currencies, right? Six will be the right answer. C. It was the interest rate at which major international banks lent unsecured funds to each other in the interbank market in London. And Libor was having the exposure to these six currencies. The rate was being calculated and published each day. In 2012, some banks were found manipulating this Libor rate, and ultimately it was termed as the Libor manipulation scandal. Also, we talk about the Libor rigging the market. That was the headline back then, 2012. It was replaced by the ARR, alternate reference rates, by 31st of December 2021. Okay, so now we have the ARRs. And here is a question from the ARRs only. Which of the following statements correctly describes the difference between SOFR USA and SONIA UK benchmark rates? So benchmark rates, what will be the right answer? Yes, ARR we will be doing. This is ARR only, alternate reference rate. I'll be explaining that. Okay, so you can join Telegram. Telegram is there. It is an open group. You can also join. WhatsApp group is specifically for the paid subscribers. Fine. So Telegram groups link, it will be posted here in the comment section only. Let me see whether it is there in the description box. Okay, in the description box, we have one Telegram group specifically for the JAIIB exam aspirants. You can join that. Also, you can follow the Instagram channel. There also we keep on updating. Fine. So Sonia and SOFR. SOFR is unsecured rate. Sonia is backed by collateral. Sonia has overnight tenor. SOFR is based on 3-month tenor. SOFR is a secured rate backed by the collateral. Sonia is unsecured rate. Sonia is only used by the banks, while SOFR is used by both the banks and non-banks. What is the correct answer here? The right answer is option C. Yes, yes, good. C is the right answer. So SOFR is secured rate backed by collateral. Sonia is unsecured rate. So when we talk about Sonia, it is an unsecured rate. So secured, no. SOFR is secured, yes. Overnight tenor, both have. And when you talk about counterparties, both have the same counterparties. Only difference is this, secured or not. So Sonia is not secured. Your SOFR is secured. Another, when you talk about ESTR, that is also not secured. So ESTR and Sonia, both you should remember. So LIBOR was replaced, and replaced by whom? By the ARRs, alternate reference rates. Fine. Alternate reference rates. These are what? Now, various markets across the globe, they have their own reference rates. Earlier, we used to say that yes, the London-based exchange rate will be applicable to all, but now different markets. Fine. For India also, we have MIBOR. Okay. So LIBOR is being phased out and replaced by new benchmark rates. What are the important ones? This table is very important. Fine, you must remember secured, unsecured, counterparties, tenor for each of them, as well as the full form and the country to which they belong. So for USA, we have SOFR, secured overnight financing rate. For UK, we have sterling overnight interbank average rate, known as SONIA. This SONIA is highlighted by because it has been asked in the past examination thrice. SONIA. EU, your euro short-term rate ESTR. Then we have SERON, that is from Switzerland. Swiss average rate overnight, that is your SERON. For Japan, we have TONAR, Tokyo overnight average rate. Fine. So these full forms are also important. Next comes the secured or not secured. So only two are secured, SOFR and SERON. Only these two are secured. Rest are not secured. Fine, not secured. What is secured? What is not secured? So secured rate is backed by collateral. Fine. Usually government bonds will be there, making it theoretically lower risk. Fine, risk is less when you opt for the secured rate. Unsecured rate, it relies purely on the credit worthiness of the borrower. When you talk about tenor, all of them are having overnight tenor only. So Indian bank, let's suppose SBI wants to borrow the funds from the Switzerland bank for Swiss franc. Fine, Swiss franc they want the currency. So they will call some bank situated in Switzerland, and the rate at which the Switzerland bank will lend the money to SBI, it will be dependent upon what? SARON, like that. Okay, so overnight funding will be there. Counterparties in case of Ceron is banks only, fine. And when you talk about others, SOFR, Sonia, ESTR, Tonar, all these are having counterparties as banks as well as non-banks. Okay, fine. So this table you should remember, right? Very important. Next, we have under which section of FEMA is a person resident in India required to repatriate foreign exchange that has become due or accrued in their favor back to India. So what is the time limit? Which is what section is there? Yes, you have to tell the section. One time limit is there, but for this question you have to tell me the section number. So the right answer is your section 8. Right? Section 8, in fact, it states that a person who is resident in India and they are required to repatriate the foreign exchange that has become due or accrued in favor back to India. Fine, it's their responsibility. So, important provisions. Section 3 of FEMA talks about prohibition in the dealings of your forex except through authorized person. Only by authorized person you can deal in the forex. Section 4, it restrains any person resident in India from accruing, holding, owning, or possessing or transferring any foreign exchange, foreign security, any kind of immovable property situated outside India. Then we have section 6 deals with the capital account transaction, the long term transaction, investment kind of transaction. Section 7 deals with the export of goods and services. Section 8, it casts responsibility on the residents in India who have any amount foreign exchange due or accrued in favor to get the same realized and repatriated to India. Fine, that is your responsibility. Okay, so for that you can do what? Section 3 only focus on keywords. Section 3 only APs, fine, otherwise prohibited. Section 4, you are whenever we are talking about section 4, you should understand that it is only for the how you can call it, transferring of any foreign exchange for outside except okay, it again provides the restriction, fine, from acquiring or holding. So just imagine like that, that the ownership criteria will be tested in section 4. Focus on the keywords only, just write them down. Section 4 ownership clause, section 3 for only the authorized person, from via the authorized person only. Section 6 your capital account transaction, CAT, right? CAT. Section 7 export of goods and services, so simply write section 7 export. Section 8 we are talking about what? The forex responsibility, just write responsibility. So one word each, you will able to recall them easily. Fine. Now let's talk about ICICI. Which of the following statements is correct regarding the establishment of the initial objective of ICICI? So DFIs, module C we are talking about now. ICICI, why we are covering this? Because it has more than two facts which we should remember for our exam. More than two. Fine. So ICICI established in 1994 primarily to offer retail banking services to the individual Indian citizens. It was formed in 1955 at the initiative of World Bank, Government of India, and industry representatives to serve the DFIs. Fine. Serve as the DFI. B is the right answer. 1955 it was formed. A very old institution. And when you talk about any kind of history or historical events of the financial markets of our country, you will find the mention of ICICI. Every evolution has the reference of ICICI, a very important institution. So B is the right answer. What all you have to remember? Industrial Credit and Investment Corporation of India. ICICI established 1955 uh, at the initiative of World Bank, Government of India, and the representatives of Indian industries. Then we have one important point. Until 1980s, ICICI was focused on project finance, providing long-term fund. But after 90s, its subsidiaries and group companies offered many more products and services. And that was the reason why ICICI had a very smooth transition from being a DFI to the universal bank, because already the subsidiaries, the group companies of ICICI were doing really good. After the globalization, it provided many products and services to broader spectrum of the clients, and ICICI Bank was incorporated in 1994. Bank incorporated in 94, ICICI Corp was there since 1955. Then 1999, ICICI became the first Indian company and the first bank financial institution from non-Japan Asia to be listed on the New York Stock Exchange. Then we have the conversion of DFI into the bank. Here you will find that we have a direct correlation between the DFIs and the commercial bank, that earlier when the DFIs were established in our country, the banks were not that much capable, but gradually the time the financial, you can say, evolution happened in the Indian market also, Indian banks also, and we now stand a chance to do the project financing as well. So conversion of DFI happened into banks, and which is known as the universal banking. It offered ICICI when ICICI was transformed into bank, and now it's working as bank only primarily, the ability to accept low cost demand deposit and offer the wide range of products which were being offered by its subsidiaries earlier. In March 2002, ICICI was merged with the bank, and it created first universal bank in India for the project financing, for the deposits, for everything. You have ICICI. Following this merger, the ICICI Limited ceases to exist as DFI. Fine. Okay. No, no, no. First was IFCI, 1948. Okay, 1948. Uh, no, no, no. ARRs are also more than five, but for our uh, particular examination, these five are mentioned in the syllabus. Okay. Apart from that, we have many. We have the Chinese one also. We have the localized ones. So there are in total, I think, eight or nine major ones. But out of that, only five are important for the exam. Okay, fine. Now let's just talk about the RBI Act sections in column A and match them with the column B. Section 19, 22, 26, and 42. How you will be matching all these? So, when you talk about section 19 talks about what? Section 19 directly deals with the business that the RBI is prohibited from transacting. Section 22, it talks about your sole right to issue the bank notes. Then we have your section 26, bank notes as legal tender guaranteed by the government. 42 with C. So, correct answer will be what? 19, 1B, then 2A, then we have 3D and 4C. Correct answer comes out to be 1. Okay, 1 is the right answer. 2 and 4 you can eliminate all. Yes, yes, good, good. You can directly eliminate from here. Na? Section 42, directly you know that CRR is there. And here you can see that only one option, the first option has 4 as C. Directly you can mark this also. Okay, so yes, this was it for your Maha Marathon. I hope that the concepts which we have studied, you will be revising these concepts again and again, because ultimately it's not about how much you read, it's about how much you revise. Revision is the key here in this particular examination. Okay, now let's move on to the last topic as we were discussing. So module D, yes. So when we talk about the last topic here, okay, so invite and your REITs. See, when we talk about the invites and REITs, what all you have to remember. Simply, the ultimate agenda is to understand that what are these investment trusts, right? So when we talk about the REITs, how they are different from the real estate. In case of real estate, you are doing what? You are providing huge amount of money, locking huge amount of money, and ultimately you will be paying huge amount in the as an upfront fee, an upfront price only. But here in REIT is nothing like that. You can have the shareholding in the real estate even when your investment is as low as 300 to 400. For the liquidity part, they are tradable on exchange, REITs, whereas real estate you cannot. Low transaction cost is there, very low. Cost is very, very low. You can see that REITs here, you will be starting off just by sharing the money, by pooling the money in a particular fund. So cost is not that high, not that big. Ultimately, when we talk about the diversification, so widespread investments are there. So you are investing in the assets, fine, your investment is invested in the assets, the physical assets, or for that matter in these companies also which are for the real estate, fine. Then we have the control, professionally managed. It is professionally managed, REIT. And how it is professionally managed? Because it has your sponsor, the investor. Sponsor is the ultimate, you can say, company which starts the REITs. Investor, you guys are investors who are investing. Then we have trustee, fine. They are doing what? The trustees are ensuring that all those rules and regulations are followed by this REIT. And in this particular REIT, we have some management services given by a manager itself. Fine. So manager is also there. So you have an entire team with you, team of experts who are handling your investments. So when we talk about REITs, they will be having one holding company, and the domestic company will be holding the physical assets, fine, on behalf of this investment trust, which is having the trustees overlook, fine. Overlook is being done by, or for that matter, you can say control by the trustees. So SPV is holding the assets, the physical assets. Ultimately, the profit from these physical assets will move up to the trustees, find the trust, and the trust will then move the funds towards the investors and distribute the cash flows on a regular basis. So what you have to remember for the exam, simply the types of REITs. There are retail, residential, and healthcare, office, and mortgage. Retail, always remember 24% of the asset in your retail stores, shopping malls. Residential REITs in your manufactured housing as well as rental apartments. Then if 10% of the investment is made in the mortgages, then mortgage REIT. Healthcare, for the healthcare focused real estate. Office REITs operating in the office spaces. Apart from that, when we talk about your invites, in invites you will find that there are almost same stakeholders will be there, but one important thing is that we have two managers, not only the investment manager but one project manager also. And why the project manager is there? Because we are talking about infrastructure investment fund. The projects are too big to handle by a single company, and these managers are what? They are full-fledged companies only. So project manager will be managing the SPVs, the domestic company which holds the assets, and ultimately the process flow will be the same. We have the invite here, one sponsor who sets up the invite, and the trustee will be there, who will be providing the trusteeship services to this invite. Asset management fee will be charged by the investment manager, and project manager will be on the O&M contracts, right? So yes, these are what simply the trusts which we are talking about. Three-tier structure is there in invite. We have the sponsors, and the sponsors can be maximum three in number. They appoint the SEBI approved trustees. Fine, sponsors are there. Then trustees will be appointed by the sponsors only. and also invite sponsors are mandatorily required to hold the 15% stake, minimum stake 15% for at least 3 years, right? So the structure is what you should remember for the examination. Okay, 3-tier structure. Fine. So yes, that's it from my end. uh, I just want everybody to be very sure that you revise whatever we have studied, and if you have missed in between this lecture any kind of topic, I want you to go through the video once again for that particular portion, because ultimately we have covered all the 4 modules here. Fine. Okay, EPS contribution. Let me just show the entire contribution to all of you. So when we talk about the contribution, you have the Provident Fund, EPF, you have EPS and EDLI. Employee share is 12% only. Employee share is 3.67 in the EPF. Then EPS employee share is nil and your employer share is 8.33. EDLI, no share in case of your employee. Employer share is 0.50, and total for EPF comes out to be 15.67%. EPS comes out to be 8.33. EDLI comes out to be 0.50. Okay. Green shoe option. Basically, what is happening? You are having some shares with you. Let me just explain it here. So when you talk about green shoe option, there was a company in USA known as Green Shoe Company. Fine. So when they were dealing with the shares of their company, what happened? One day they were supposed to issue 100 shares, but ultimately the demand rose to 200 shares on that particular day itself. So they devised one mechanism that from the next trade, what we will be doing, we will be putting in some buffer, some additional shares, let's suppose 15 shares. So whether these 15 shares compensate for the additional 100 shares, no, but they will fairly reduce the market volatility. Because if you don't receive the shares and the demand is quite high, it might be detrimental to your share price. Okay. So basically a price stabilization mechanism, or for that matter, supply mechanism is there under the name of green shoe option. Right? And why the name green shoe? Because it was started by a company in USA known as Green Shoe Company. Okay, so buffer is there. Anchor investor, simply you are doing what? The investments which are being made by the investors, various investors, we are providing it to the parties. Fine. We have angel investors, we have the venture capital funds. So here, in case of angel investors, the funding will be done how? You are providing funding to the companies who are only having the process of prototype. They are in the process of making a prototype. They don't have a final product. They are startups, but still they are not having any product, or for that matter any process that how we will be expanding our business. Venture capital fund, the venture capitalists, they invest in those startups which are new. They do not have that market exposure, but they have a finalized product and they know how they will be expanding the market. Okay, fine. These are the angel and VCFs, the investors which we are talking about. But when we say anchor investor, they are not at all linked with these two. These two are totally different. Anchor investor are what? They are the investors. The investors means the mega players in the market. They are your QIBs, qualified institutional buyers, right? So QIBs are what? Ultimately, the QIBs will provide the funding to the players who want to expand, and these QIBs are the big financial institutions, like we have HDFC Bank, or for that matter we have SBI. Some mutual fund houses will be there. So these are the big investors investing in the market. Okay, and their investment is not in lakhs, not in crores, but hundreds of crores. So majorly when we talk about the voluntary issue, compulsory issue, SEBI prescribes that yes, QIBs must be the front runners at least in the compulsory issue, so that our institutional investors, the retail investors, do not lose their money if the overall IPO is risky. Yes, these are the two investors, na? Angel and the venture capitalists. They will be investing. Okay. So yes, thank you everybody for attending the class. I hope that the class was fruitful for all of you. And now, when we talk about the remaining time, what we should do in this particular time after 12 p.m., you should focus on revision. Everybody must revise. Secondly, you should also try to attempt one mock, just one mock, and do nothing else. Revision plus one mock. That will give you the kind of practice you need just before entering the examination hall. Okay. Angel investors are those. Fine, they are just investing, and as soon as the company is having the final product, they will be moving away and just passing the baton to the VCFs. And once the VCFs provide the funding to these particular companies, and these companies also become profitable, the VCFs will do what? The venture capitalists, they will be exiting the overall investment portfolio of this particular company and moving on to provide funding to the others. So every investor goes like that phase. But primarily you will find that maximum funding for the startups who have idea, it goes from the venture capitalists. Full length mock if you have time. But firstly, revise. If you revise, and after that, when you talk about the time you have, then definitely attempt one mock. Yes, bilingual 6 p.m. No, no, not mandatory. Not mandatory. Passport size not mandatory. Okay, okay, not an issue. All the best, everybody. I know that many of you will be now switching off their phones and just doing their studies. So if you are not attending any session, then definitely go tomorrow with full confidence, enter the examination hall as if you know everything, and try one thing, that is attempt 100 questions. If you attempt 100 questions, then only it makes sense of giving the exam. Fine. If you're not attempting 100 questions, just thinking that I will attend 70 questions with full accuracy, there is no such thing. Okay, try to attempt 100 questions. That is what I want from everyone. Fine, all of you, and whosoever is watching this video in the recorded format, do let me know in the comment section that you will be solving 100 questions by typing 100Q. Okay, fine. So see you guys tomorrow with the, you can say, morning sample paper. We will be coming up with one sample paper session in the morning, early morning, and by midnight the Chalisa will be uploaded. Okay, so these two sessions are there for you before you enter into the examination hall, and in between today also some session will be aligned. So primarily focus on Chalisa, the sample paper session, and yes, that's it from my end. All the best, everybody, once again. Yes, yes, attend 100 questions. Sample papers in the morning, 5:30 a.m., something like that. Yes, 100 questions. Definitely. That's the ask. Okay, because IFS is a difficult examination. If you are not attempting 100 questions, you are already letting go some marks, and we don't have negative marking. Yes, yes, English, in English only. Chalisa will be in English, and sample paper will be, I think, conducting the same session, fine, on both the channels, but in English. Fine, we'll try that it should be in English. Plus, for all of you, one more important information. Tomorrow, we will be starting off with the paper discussion once the exam is over. So all of you who are having their exam in first shift, they should provide us with the questions, fine, as soon as they are available, fine, as soon as you exit the examination hall. Try to I know it's a bit tedious task, but try to give us some questions, because ultimately we want that everyone, your colleagues also, your friends also, your classmates also of these sessions, they must benefit, fine. So your input will be very essential for all of us. And for the second and third shift students, I would highly recommend that do watch this first shift analysis, fine. And for the third shift paper, if you are having the exam in the third shift, then do watch first as well as second shift exam analysis, because ultimately what we have seen, that IIBF repeats the questions, fine. Okay. Chalisa is basically one small session, small in the sense we have prepared a session out of all the important topics, and we play it on in 2x speed, 1.5 or 2x speed. Okay, red herring prospectus is what? Everything is written about the particular company, starting from the basics, that who will be the sponsor, who will be the promoters, till your final, you can say, composition of the entire company. And you will be floating that red herring prospectus in order to decide the share price, fine. Price of the share will be decided based on the company's portfolio. Right? And why red is mentioned there? Because earlier, now though mostly things go digital only. Earlier, when pen and paper were used, it was signed in the, I think, top left or bottom left with the red ink. It used to be signed with the red ink. Okay, so Divya, if you have the questions, then do share with us. Fine. Okay, in the comment section, you can directly share of this session or the session which will be aligned tomorrow. Uh, Sangeeta, time for the first shift analysis will be 10:45. Fine, we'll start by 10:45. So as soon as the inputs come from the students, we will be going live. Yes, yes, prices are not there. They will be decided. Okay, so thank you everybody for attending the class. Do revise in the remaining time period, and do not forget to attempt all the 100 questions. That is the minimum ask from all of you. Right. So we'll see you guys in another sessions, whatever you are attending, and try to be consistent till your examination. Fine. After IFS, you have PPB exam also. Have a break after IFS examination, but stay in the focused mode, because you have to crack PPB also. Okay. So goodbye, everybody.